Um,
Yes.
okay, thank you. Thank you. So welcome to this webinar, a 3-hour webinar on value investing, evolution and application. So let me thank you again for attending. I know it's a Saturday afternoon and for many of you, it's family time. So as what Rob said, yeah, we're quite amazed, no? And also pleased that to see people who are registering for this webinar, so, who exhibit the same passion to learn, which we think is, as you will see later, is one of the key lessons in value investing. So, just to give you a background on why I'm doing this, a few months ago, so as many of you, so I had a chance to reflect. What do I want to do? What for over the last 10 years? I have there's no other philosophy that has influenced my life as value investing. And I'd like to share especially because I see the list now. We have more than 100 registrants, and most of you are students. So I'd like to share some lessons that you can take away after this webinar that I think is life changing, because the value investing, the lessons that in value investing, it's not only about investments. It's not only about investment philosophy. It's also a life philosophy, and I'm confident, no, that it will change your life as much as it did mine. No? A few months ago, I conducted a similar webinar on value investing for the Ateneo Center for Continuing Education, and conducted a 5-day course on value investing. Um, the feedback that I got there is very encouraging, very inspiring even. So some of them, like if I have here the reviews, so endorsing the course, they endorse the course as inspiring, transformative, and life-changing. Now, this is how this is reviewed by the participants is a testament of the power of value investing as espoused by Charlie Munger and Warren Buffett, not only for investments, but also for life. So value investing, as what I said, is a philosophy that I am very, very happy that I took seriously 10 years ago, because it has changed my life profoundly, whether personally, financially, emotionally, in every aspects of my life. I became a better father, a better banker, and a better investor in the process. So my objective here is very simple. We are 20 days into the new year. And in 2 weeks, I think it will be Chinese New Year, or more in 2 to 3 weeks, we Chinese New Year. So what I'd like to achieve today is very simple. I'd like you to take a simple decision. I'd like you to make a simple decision, especially if this investing philosophy is for you, to take the simple decision to act, and to pursue further the study of value investing. And if that is in line with what you want, throughout this webinar, which will be a 3-hour webinar, I will share with you some resources that you can immediately use, some books and reading materials that you can immediately use after this session. So if you stick with me for the next 3 hours, I promise that I will deliver as much value as I can. So I'm especially flattered, to be invited, and happy to be invited by the CFA Society, because I'm also a charter holder, CFA charter holder. But I think what many of you don't know is that there is a strong connection between the CFA program, CFA Society, and Benjamin Graham. Benjamin Graham is the father of security analysis. So he wrote this, a Bible of security analysis. This used to be the CFA books before we have all this formal CFA, the official CFA readings, security analysis and intelligent investor. And he was the first person if I am not mistaken, in 1922, who advocated for the professionalization of security analysis. So there's a strong connection between the CFA program and Benjamin Graham, who is the father and founder of value investing, the mentor and teacher of Warren Buffett. Okay. So maybe before I begin, let me just start with 2 stories. Okay. So I usually begin my value investing talks with this story about 2 different people, and this will set the tone for our discussion the next few hours. Okay. So the first person, let me start now by introducing you with this person. The first person is Anne. Okay. So by the way, these are not fictitious people. These are real people. So this is Ann Scheiber. Not many of you know her, but Ann worked as an auditor for the Internal Revenue Service, which is the US BIR, for most of her working life. And she earned only a salary of $4,000 a year, $3,000 to $4,000 a year. Okay? Because of her difficult life experience, she saved as much as she can and invested all her earnings in the stock market. Because she found out that is what the rich people do, her clients who she's auditing as an auditor of the IRS, that's what they're doing, investing in the stock market. So simple decision, I will invest all my savings with this in the stock market. So it happened that his brother is also a stockbroker. Unfortunately, her brother's brokerage firm went bust and took whatever money she has. So remember, as she saved everything she can, she would find all the opportunities she can to save, would not buy new dress, wouldn't buy expensive food. So at age 38, she lost all her savings. That's when she decided to take ownership of her future and study investing her own money by herself. She saved as much as she can, and she was able to save $5,000, start again. So she lost her money, then save as much as she can, then started again. And then she retired on a $3,000 per year pension. Not much, even by the standards at that time. She spent her retirement years studying about the markets, reading research analyst report, newspapers, and magazines. Sticking to what she knows, she loves movies, celebrity gossips. So what she did is she bought some Hollywood stocks. She would attend stockholder meetings and ask tough questions. In other words, she took ownership of her own investments. And by the time she died, at age 101, she had a portfolio that is worth $20 million. She almost never sold any share and bought only small amount of shares at the time. So $100 a share per month, $100 equivalent, 100 shares a month. Her lawyer, when she died, examined her portfolio, and he said, what he said was quite amazing. He said, she had around $21,000 in her portfolio in 1936. And if you just let that money grow and perform at par with the market, it will grow to $22 million because of compounding. What does that mean? Nothing special with her skills. Okay? So Ann is a very powerful story of a very, very important concept, which I will discuss. All of you have a book knowledge about this concept, compounding. Everyone knows what compounding is, but I think very few people I know really know the deeper meaning of compounding as to how it will apply in our day-to-day life. So I want you to remember this story of Ann Scheiber, because I will discuss. I will introduce you to another person, Rick. Okay, Richard Fusconi. Rick, he is an investment banker. Okay, he worked in the same industry as Tony and myself. He's also in financial markets. He's the vice chairman of Merrill Lynch, building the largest fixed income trading and client franchise on Wall Street for Merrill Lynch. Very knowledgeable on finance. So he does all these esoteric derivatives, fixed income derivatives. Advanced knowledge on the mathematics of derivatives. Arguably, one of the most complicated and complex, complex area in finance. We call it the high finance. Very knowledgeable. In fact, this is So this, by the way, what he does is also my full-time job. I'm also on the derivative side, so of the business in the financial market. So I'm quite familiar with what he's doing. What he's doing is more complicated. And if you look at what is his profile, he studied MBA at University of Chicago, Harvard Business School. He studied history. He's the CEO and chairman of an investment advisory firm. So in short, he is someone. He will fit the typical profile of the typical CFA profile. Very knowledgeable with complex book knowledge. And then what happened? In 2010, he filed for personal bankruptcy. So I was intrigued. No, I researched. So you can find him in LinkedIn. He's doing a pro. He's accepting consulting engagement now on financial markets, on the markets. Yeah. So when he was interviewed in 2010, so what he said is this: I have been devastated by the financial crisis, which came to a head in March 2008. One of the most knowledgeable people in finance at the top echelon, no, or in terms of financial sophistication. And he did so because he has no income. I currently have no income. So if you compare these two stories, Ann Scheiber and Richard Fusconi, if I ask you, it's in this room, no, in this room, I don't think most of you here, the fact that you are interested to attend a webinar like this would be more knowledgeable than Ann Scheiber. And most of you here, in fact, all of us here, I think no one will be more knowledgeable than Rick Fusconi. So then I was intrigued, no, 10 years ago, or more than 10 years ago, when I started this journey in understanding value investing. What is it that sets apart financially successful people or rich people versus the non-financially successful people, the financial failures? What is the distinguishing characteristic? It's not CFA, it's not book knowledge, as what we have seen in Fusconi. It's something else. And that is what I want to discuss with you. I think this is an urgent message, especially for those of you now who are spending your time in quarantine, lockdown, or you have time. Because I would argue that the message of value investing would not would resonate to most of you. And what I would say is you have to really act on this, because I will tell you now, the difference between Anne and Richard is not book knowledge. The difference is what? Temperament and behavior. And for temperament and behavior to work for you and not against you, you have to take this topic, this subject seriously. So what are we here for? Okay? So by the way, let me just give a brief introduction, because I'm not a fund manager. So I manage fund, my own personal fund and my family's fund and my friends' funds. But I've been a value investing practitioner for a very, very long time, for more than 2 years. Yeah, so I'm currently, as what Tony said, an FX and rates structurer, so derivatives, similar to what Rick Fusconi is doing, based in Singapore. So I wrote a book on bank risk management, and I'm teaching derivatives and risk management. So I'm doing this part-time. And recently, I launched several value investing courses. Why? Because I have been, what many of my friends don't know, so they know me as a derivatives guy, but what they don't know is, having been deeply inspired by the story of Ann Scheiber and Richard and Rick Fusconi, I embarked on a study of philosophy over the last 10 years. So 10 years ago, I was on this decision point. So I saved money for a US MBA, so around $100,000 at that time. And I decided, should I spend this money on MBA, or should I spend it to something that is more worthwhile than MBA? And I decided to allocate resources to use that fund to educate myself and design my own master's program. So I called it MBM, Masters in Buffett and Munger. And I'll tell you why later. Why did I choose these two guys? Why did I study? By the way, this will be a pretty immersive seminar, because I've conducted this many times. So what I'd like you to do is this will be not one of your, because I think for many of the webinars that some of you have attended, the free webinars tend to be an introduction or a marketing ploy for a bigger course. No, this will be a standalone webinar. So therefore, I intend to deliver as much value as I can. So what I would like to request from you are two things. Please take down notes. I'm distilling 10 years worth of wisdom that based on my study, of course, to around 3 hours, to close to 3 hours. So I believe in the importance of this message. So I urge you to take this seriously. So don't worry, I will give you a copy of this slide. So through the CFA Institute, we will send you a copy of the entire slides. So just take down notes if there's any area which resonated. And second and most importantly, I would like you to keep an open mind. Okay? Because some of the things that I will tell you may be counterintuitive. So yeah, so just give me the next 3 hours, keep an open mind. And also number three, if you can actively participate in the chat, because I want to play a short game later. So I'd like you all to participate. Okay? So if you can, if you can, because I think that would make the learning process more enjoyable. Now, during the pandemic, I read this book. By the way, I highly recommend that you read this book. This is a book that was written I think if I'm not mistaken, around 5 to 7 years ago. But the message of this book is very relevant in the context of the pandemic. So let me just excerpt one quote to establish what are we here for. We are in the midst of an extraordinary transition that few of us are prepared for. Okay? If we get it right, it will be a gift. To ignore and fail to prepare will be a curse. So this crisis, this pandemic situation could either be a curse or an opportunity. And I'd like to tell you that in my opinion, because now I had this benefit of hindsight from looking at my 10-year-old self, because I write everything, I keep a detailed journal. So I'm very thankful for the decision that I made 10 years ago, more than 10 years ago, to embark on this journey to learn to learn and practice. More importantly, to practice value investing. So there will be a rebalancing in the coming years, and I would like to contribute in that discussion to help you transition and thrive with these changes that's coming. So how do you do that? That's what Rob said a while ago. Learning a new skill. And now, of course, when learning a new skill, the question is, what skill should you learn? So I have two kids now. So I was thinking, when I grow older or when I grow old, whatever I do now, whatever skill that that I invest on now, should be something that as I grow older, I get better. So I would argue that there is no other skill where, because most of the skills, for example, I used to be a derivatives advisor, or now I'm a structurer. So as a structurer, I can notice your cognitive skills. As you grow older, your cognitive skills becomes how do I say this? Less suited for structuring. You're no more in financial markets. As we grow older, maybe we would have less energy to do structuring. But so 10 years ago, I asked myself, what should I do? What should I invest on? What skills that if I spend the next 10, 20, 30, 40, 50 years, as I grow older, I will never retire. And if you ask me, that skill is investing. In investing, as you grow older, you become better. You recognize patterns. In fact, if you look at the greatest investors of our time, whether it's John Templeton, Warren Buffett, 90 plus years old, Charlie Munger, just turned 97 years old on January 1, and Irving Kahn, Walter Schloss, these legendary investors, they get better as they go older. So I would argue that investing is a skill set that you should invest on, because investing as a skill set compounds over time compared to other skills where you depreciate over time. So in my industry, in the financial markets, so we're generally the pay is quite okay, but I was surprised when I see some people in my industry with struggling with their finances, despite getting paid more than average. So it seems to me that the more they're paid, the more they seem to discover more needs. It's like what the philosophers are referred to as the hedonic treadmill. So it's an endless exercise where your happiness never goes up, even as you acquire more resources, more worldly resources. Your expectations on life merely changes. So the more they earn, the more they have to spend. And the sad thing is, in my industry, say derivatives, as what I said, skills are not exportable. So up to a certain age, after let's say after my tenure in the banking industry, it's hard to think about what are the alternatives, what are other alternative career paths that I would have, that I could pursue. This is the reason why I decided to invest time and resources to study value investing. And then I found, no, by the way, this is a very powerful quote from Warren Buffett, who is one of the most popular proponent of value investing. And he said this. Listen to this, because I think this is a very, very powerful quote. And I think it was a good New Year challenge especially for the students attending this webinar. If you don't find a way making money while you sleep, you will work until you die. Okay? So investing is the only skill set that I can think of now, other than entrepreneurship. For those of you who have the natural inclination or aptitude to do it. But investing is one of the skill set that if you spend the time on and time and resources on, and if you're passionate and dedicated about it, you will find a way to make money even while you sleep. Okay? So, and later I'll give you some practical tips on how to. By the way, don't worry if now, because we're just on the introduction. On the last phase, I'll tell you some concrete ways and share with you what I learned over the years, and how to show how to have a concrete plan in pursuing investment learning. Okay, so I'm in, of course, naturally I'm in the financial markets. The national heroes would be the traders: George Soros, Julian Robertson of Tiger Funds. Jesse Livermore. So these are the legendary traders. Okay, but then I decided whoever will be my mentor for this project, to learn a new skill, a future skill, it should qualify 3 main criteria. I believe that I believe that it should qualify. Whoever your mentor is should exhibit 3 main characteristics. They're rich, they're happy, and they're rich, they're happy, and they're healthy. They live long, they're financially prosperous, and they're happy and satisfied with their life. So I realized, reading so many books and biographies of people I admire, the happiest people I know are those who have freedom and independence to do what they want, such that they don't have to depend on their employment income, because a lot of things can change if you are free, if you don't have to work for a living, if you don't have to trade time for money. Okay? Now, I found the answers in 2 of my greatest teachers and heroes, Warren Buffett and Charlie Munger, very old people. So as what I said, I have a simple definition of success. They should be wealthy. They are both billionaires. Healthy. No one can argue. Warren Buffett is now age 90, and Charlie Munger just turned 97. And happy. Their children still come home to them. They can do what they want. They can choose to spend time with people they like. So they are well respected and admired. In fact, every year, Tony and I were just discussing, because I was planning to go to Omaha last year. I went to the Charlie Munger. Daily Journal meeting, but I was planning to fly to Omaha, but didn't happen because of the pandemic. For those of you who are not familiar, the admirers or value investing practitioners, they will go every year in May, a week before Mother's Day, to Omaha to hear words of wisdom from Warren Buffett and Charlie Munger, and there will be tens of thousands of people falling in line and wait 3 a.m. just to get a seat, and hear them speak in person. Okay. So this webinar provides a palette overview or dim sum overview of their philosophy, which what we call as value investing. Okay. So how my journey started, as what I said, I was thinking of taking an MBA 10 years ago, but I decided to use my MBA money to buy books, attend courses, on value investing. So I read, so as what you can see here and outside in my library here and in Philippines, I collect, I'm a Warren Buffett and Charlie Munger, Berkshire Hathaway fan, their company. So I read many investment books, particularly value investing books. So I started with book learning. Then I developed my own personal program, a 2-year program, which I can share with you after this webinar. If you want to pursue it yourself, a 2-year curriculum, which I call MBM, Masters in Buffett and Munger. So it's a very intensive course. I will wake up every day, 4 a.m., because I have 2 kids, just to study and read every day, Monday to Sunday, 4 to 4:30 a.m. Sometimes 5 a.m., but usually 4 to 4:30 a.m. So I go out of my way, flew to the United States to hear Charlie Munger, attend Value Investing Congress, Value Investing events. I attended this course by Whitney Tilson, who is a famous value investing practitioner, although he closed his fund recently because he shorted Tesla. So I attended the Monish Pabrai, so another legendary value investor, Monish Pabrai meetings in Chicago. I was very serious about I used almost all my leave to find an angle, to find a way to study value investing. I even traveled to India and met this great value investing professor, Sanjay Bakshi, to study value investing in Pune, India. I fly almost every year to Pune, India, because there's a vibrant value investing community here. By the way, the reason why I'm doing this, I think Chris Arceo is here, so as part of the CFA Institute. So thank you for inviting me. So she was the one. So I was discussing with her. So I was surprised given the historic connection between value investing and Benjamin Graham, the proponent of value investing. There's not much value, at least in Asia. In the US, I can see. In India, I can see. But in most of Asia, especially here in Singapore, I can no longer distinguish between the Chartered Market Technician Association and CFA. Because there's not much interest on value investing in the recent years. So my goal is to really build a network of like-minded thinkers. And I was surprised when I first launched this webinar 3 months ago. I found some very veteran investors, even businessmen, full-time businessmen who are passionate about investing, who are studying Warren Buffett and Charlie Munger value investing for how many years. And we were able to create a network, a community where we can discuss investments, discuss philosophy, discuss how value investing is evolving. So one of my objectives is to create a community. So later I'll give you some details if you wish to join that community. I would regularly send newsletters and resources, and create a WhatsApp group for us to discuss how to help each other pursue further our value investing study. So my objective for this webinar is very simple. Only 3 objectives. So first things first. Okay. So by the way, because I think so for many of you have been following value, or especially if you're a value investing practitioner, we have one big shortcoming. The big shortcoming is we tend to have this elitist or moralistic attitude towards other philosophies of investing. For example, value investors tend to look down on growth investors, on momentum investors. So what I want to say is this: I studied investing philosophies other than value investing. So as I said, in my area, derivatives. So we don't really study value investing. In fact, the philosophy that we are most aligned with is the efficient market and the arbitrage pricing theory. For those of you who are here, you will be familiar. But it's definitely not value investing. So the point that I want to make is this: there is no one path to make money. Okay, so don't get me wrong. For me, value investing works. Value investing is superior. But there is no one path, one way to make money. Growth investing can work. Momentum investing can work. If you are an indexer, EMH, if you believe in efficient market, it can also work. Okay, so do not take this as a statement. No, but I believe personally that value investing is superior. Okay, so but then there are many ways to riches and not just one. So what I'd like to do here is to help you understand what is investing, what is value investing, and see how does this fit, or whether this fits your investment philosophy. So so I will show you how value investing has evolved over the years. By the way, if you're reading Benjamin Graham, Intelligent Investor, it's not the value investing that Warren Buffett practiced anymore. Okay, because value investing evolves. And later I will share with you one of my favorite value investors on the high yield, on the fixed income side, Howard Marks. So he recently published a letter. So talking about value investing and growth investing. Is value investing really dead? He has some very interesting opinion on value investing. So I will discuss that very briefly later. Second, so what is value investing? What makes it different from other types of investment philosophy? Second, why study value investing? Okay, so, and you would be surprised, for the students here, especially for the students here who are just starting out, there is a very, very good reason why you should study value investing now. Okay, and I will discuss that later. So whether you're currently out of work, whether you're a full-time employee, a student, a businessman, doctor, student, there is something that value investing can offer to you. And lastly, okay, if you can still stay in this webinar, if you can extend, because I might need to extend how to practice value investing, how to learn value investing, and what are the resources that are available out there that you can use. So I'll give you some of many of those. And as I said, I'll share this presentation plus other readings that help me in my Masters in Buffett Munger program. Okay, so let's start. What is value investing? Value investing is a philosophy. It's a framework, an orientation, and a process of investing. So let me discuss this in detail. So let me start. What is value investing? So value investing as a philosophy. So Nietzsche once said that all philosophy is autobiographical. So we have to study the life of the founder of value investing, which is Benjamin Graham. So he wrote two very popular books on investing: Security Analysis and Intelligent Investor. Okay, so let me just to understand what is this value investing philosophy, we have to time travel and go back to the past. What is the world? How does the world look like before value investing? So this is the economic environment then. So in the 1920s, it was in the 1920s that the value investing philosophy was formed. It was a decade of economic growth, excessive economic growth, and widespread prosperity. So the United States is seeing new innovation technologies, Hollywood, cars, automobiles, radio, media, and everyone is saying this time is different. The president then, so very, very familiar, although now we have a new president in the United States, but the president then was President Calvin Coolidge, who is a free market president. Okay? He famously remarked that government should not intervene, that the chief business of the American people is business. So the stock market keeps on going up, so like what's happening now. And you know what? The fear then was not the fear of losing money from the stock market. The fear then is the fear of missing out. Okay? I will miss out on the gains. Okay? Now, it was in this environment that Benjamin Graham started investing or learned investing. He was a young Wall Street professional. He was able to build a sizable investment over 15 years, and he chose to go all in the stock market. And not only that, he borrowed money like everyone else at that time. To be fair, that was the convention at that time, because markets keeps on going up. It's almost no risk. So borrow money to invest more. So leverage through margin loans, margin financing. Okay? And then what happened? The stock market crashed by 89%. One of the worst in history. Billions of dollars were lost in market capitalization. And investors, including Benjamin Graham, lost money. So remember, these are the events that shaped Benjamin Graham's world. And not only that, in 1907, 15 years before this actually, his mother invested in a company called US Steel, only to lose 49% of its value within 22 months. Benjamin Graham repeated the same mistake in the 1929 stock market crash that almost cost him not only his career but also his sanity. Okay? If you live through that era, so if I ask you, what would be your attitude to investment? So maybe I'll take this opportunity to see if you're still listening. Can you reply in the chat? If you live through this era and if you're Benjamin Graham, what would be your attitude to investing? Would you be conservative or aggressive? What would be your approach? What would be your mindset? So if you can chat chat in the type in the chat box, so I just so I know so I just know just see if you are okay. Ken, yeah, risk averse, probably conservative. Yes, you're right. You're right. So a generation, in fact, they were so conservative that a generation of investors, found the stock market to be traumatic. Okay, so they never became equity investor. Now, why am I saying this? Just remember this, the limitation. Okay, Angelo, you take more risks. Okay, good. But for most people, because as what I recently watched a documentary about Charlie Munger. If you lived through those times in the 1929 and suddenly you invested everything and lost 90% of your value, your attitude to investing will of course change. Okay. I understand that we are in the market now where we saw the 2020. Early last year, stock market went down significantly, but only very briefly. But it was an entirely different paradigm then. Okay, so at least good that you'll take more risk, and assuming that you're not fully invested at that time. Yes, that's right. You should. I think that would be the proper attitude. Okay, now it was in this kind of environment that the value investing philosophy that Benjamin Graham conceived of this value investing or formed this value investing philosophy. So Benjamin Graham is the father of value investing. By the way, the reason why I'm discussing this is because you have to know this. The key to understand the limitations of an investing philosophy is to understand what are the circumstances that led to the birth of this philosophy. Okay? So you will see, there's one reason why there's one main shortcoming or weakness in value investing. That's why it's not performing in this market, because there's paradigm. So Angelo, to answer your point, there are paradigms. So good that's your approach, but there are paradigms that inadvertently led some people to exclude good investments or to exclude certain information. New information or update their information, update how they understand the world. But thank you for commenting. So Benjamin Graham is the father of security analysis. So CFA owes their existence now to Benjamin Graham, our intellectual forefather or intellectual grandfather, whatever we call him. He's the dean of investors, the dean of Wall Street. Taught value investing in Columbia. By the way, I also took some courses in Columbia, value investing courses in Columbia. And they have very good value investing course. I'll share with you the materials if you're interested. Feel free to reach out to me. They're very, very good. And was the mentor of many great investors, including Warren Buffett, who learned investing from him. Because Warren Buffett started out as a chartist. So he read the same book, the Murphy book on technical analysis. And then he discovered this man. He read the book, The Intelligent Investor. The story is he was not accepted in Harvard, and he found out that this guy, Benjamin Graham, still alive, not some old man who died already, still teaching at Columbia. So he decided to pursue, after being rejected by Harvard, to pursue his MBA at Columbia. And up to now, there's still a strong tradition of value investing in the Columbia Business School. So he's the intellectual father of many investors and published two of the greatest books on investing. Now, prior to, Salve, thank you. I'll send you. I'll share my email later. If you're interested, I'll send you copies. They're very good. Okay. But just don't post it publicly. because I might, yeah. So it's only for your own, because I want to help you. Okay, so here, prior to Benjamin Graham, there is no clear and formal definition of what investing is. There's no clear definition. Okay, what activities constitute as investing activity, and what activities constitute as speculative activities. So at that time, there are many misconceptions. So some say, oh, maybe it's the type of financial instrument. If it's a deposit and bond, it's an investment. But if it's stocks, then it's speculation. So is this correct? So you all know it's wrong, right? So if you place your deposit in Lehman Brothers, you would have lost all your money. Okay? But if you deposit that in a safe equity, say Ayala Equity, whatever, Meralco, even though the instrument is equity, there's no guarantee of principal repayment. There's no promise not to pay principal, subject to market risk. Still, I would argue that it's safer. So what Benjamin Graham said is wrong. It's not about the type of instrument. It doesn't matter what your whether it's a deposit, what the legal format of the instrument is. Right? So it's not about the type of instrument. Or okay, second, is it about your horizon? If my horizon is long term, maybe I'm an investor. If my horizon is short term, then maybe I'm a speculator. So I know that one of the popular quotes of Warren Buffett is that my favorite holding period is forever. But then again, that's another sickness of value investor. Be careful. I see some of my value investing colleagues, friends, if you discuss these things, so with them, one of the main weakness of value investor is this. The thinking that because Warren Buffett said that my favorite horizon is long term, therefore, I should hold an investment as long as I can, even if I'm losing money. Even if the fundamentals have changed significantly, that is very dangerous. In fact, I'll tell you a story later if we have time. When I started, so I committed a very big mistake. I lost money on one investment, on a coal stock, US stock. Because why? Because it used to be one of my favorite stocks when performed well, but then I neglect how do I say? I ignored the signs, that the tide is shifting against coal. Right? It's a stubbornness on my part. So one of the key weakness of value investors is stubbornness. So Benjamin Graham said, no, wrong. It doesn't matter what your horizon is. In fact, he said this: investing in a bankrupt company or a zombie company, even if you hold it long term, is speculative. You will lose money. Right? Another, if it's my own money, then it's investment. If I use other people's money, so meaning borrowed fund, then that is speculation. Again, it's illogical. It doesn't matter whether you invest your money or you invest other people's money. Or maybe it's because it's a source of income. If my source of income is dividend and interest, then that's income. Then that's an investment. If my objective is to earn from capital appreciation, then that's speculation. Again, wrong. This, according to Benjamin Graham, this does not distinguish investment and speculation properly. So, to me, one of the revolutionary the changes or legacy of value investing is the proper definition of what investment is. By the way, if you look at this simple definition of investment, it could apply to anything, whether it's value investing, growth investing, and even quantitative investing. So according to Benjamin Graham, he defined investing as this: an investment operation is one which, upon thorough analysis, so thorough analysis, wow, it's a revolutionary, because before, it's not about analyzing, it's following the trend. The trend is your friend. Okay? Promises, what's your objective? So number one, he said, yes, investment can be a science and an art, not only an art, not only something that not something that's not random, but can be something that is scientific. Right? thorough analysis. That's why the title of one of his famous books is Security Analysis. Promises what? The objective is what? The objective is, number one, safety of principal and a satisfactory return. Operations not meeting this requirement is considered as speculative. Now, let's dissect this definition. Investing is first and foremost an operation. Operation means what? Operation means an organized activity, which is why Warren Buffett likes this. By the way, when Warren Buffett was 11 years old, he started investing. He's applying technical analysis. He read the book by Murphy, that famous technical analysis book. So the thing that attracted Warren Buffett to value investing is this simple word, operation, because he saw for the first time someone said that investing can be a disciplined approach, a structured approach, something that a scientifically minded investor like Warren Buffett would want. Organized activity of what? Thorough analysis. Oh, this is the first time that someone said that investments can be analyzed thoroughly with the use of reason and logic and not just reading charts and emotions. That you can gather and organize facts and apply an objective standard and decide accordingly. And in return for what? In return for two things: safety of principal and satisfactory return. Now, I want us to stop for a moment, and then can you dissect this word, safety of principal and satisfactory return? Is this something that's sexy and powerful, or this is something that's very moderate? And what's your sense? What's your sense from your perspective? Safety of principal, is this an aggressive? It's boring. Yes, exactly, Carlos. It's a very boring definition. Your objective, what? You're attending 3 hours, or if you attend my 5-day course, your objective is simple: safety of principal. And what? Not outrageous return, but what? Satisfactory return. You're right, Carlos. That's the exact word. Boring. This is a very boring objective. Okay? Now, this definition is one of the distinguishing characteristics of value investing. Yeah, I'll share with you the memo that was written. It's one of the best letters written by Howard Marks. And if you've been following Howard Marks closely, Howard Marks writes good letters, great letters even, for decades. And this is the best. So he kind of said that this is one of the sickness of value investors, or weakness of value investors. Okay? We are very defensive. Value investors tend to be more defensive than other types of investors. Because why? The history. Because this philosophy came from a very, very how do I say this? A very, very bad period, one of the worst periods in the stock market. So again, this is one thing that we should overcome, if we want to progress and understand, or expand our horizon in terms of investing. But you're right, Carlos. This is a very boring and defensive definition. In fact, if you remember, one of the famous quotes of Warren Buffett is this: rule number 1, never lose money. Rule number 2, never forget rule number 1. It's a very defensive investment philosophy. And as what Howard Marks said, value investing is a negative art. We always say no, especially bond investing. We say no, 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 until we find something that we like. Because why? Our main objective is not to lose money. We're very conservative. Now, this led to the publication of 2 of the most influential books. So I have almost all the editions of Security Analysis and Intelligent Investor. By the way, if you're very serious on value investing, these are the 2 books that you should read. And Carlos, these are very boring books. So I struggled at the start, but as you absorb this philosophy and study this philosophy, this becomes intuitive, and it's a very good study. In fact, I'm thinking of conducting a Bible study of security analysis. Yeah, you need lots of coffee to read those books, correct? And motivation, because remember, we're going to the time to a time when a very unfamiliar period where financial statements are not required to be published on a quarterly basis. Accounting standards are not uniform. So there are many things that's very different at that time, but this is one. Okay, this is one of the most rewarding books to read, security analysis. And I'm planning to conduct a Bible study, security analysis, on weekends, either through Ateneo or through CFA or through Inquirer Academy. So I'll let you know. Please get in touch with me. So that led to the birth of this philosophy. Oh, thank you. Thank you, Salve. Okay, so here. Now, what I want to challenge you on is this, not to blindly accept this philosophy, but I want you to form your own investment philosophy. And in my 5 days course, I teach how to do that, but I'll give it to you in a nutshell how to do it. What is an investment philosophy? An investment philosophy is a set of core beliefs, a coherent belief that you can get back to in order to generate new strategies when old strategies no longer work. So by the way, if you're looking for a more, let's say you're not yet convinced that value investing is the best philosophy, it's good. So please read this book. Yeah, Robert. Okay, yeah, good. Robert read these books. Yeah, but it's very boring, right? So, but now I love it. I read almost all the editions. Yeah, especially the sixth and the 1934 edition. Now, for those of you, okay, yeah. So for those of you, okay, who are still exploring, and this one is a very popular. This guy, Aswat Damodaran, is a very famous CFA speaker. Okay, so he attacks Warren, one of the few people other than Nassim Taleb who attacks Warren Buffett because of this moralistic tendency of value investors. So he has a good book, Investment Philosophies. And the good thing about this professor is he makes this available for free online. Please read this. So he kind of gave a palette or survey overview of the different investment philosophies. So if you're not yet convinced that value investing is the best philosophy, that's okay. There's no one path. You can go and revisit and come up with a more objective overview of what are yes, Mr. Valuation. But yeah, I'll discuss I'll discuss some resources. He's a very good, very intelligent guy. Although of course I'm on a different side. So he's more how the enterprising in his valuation. He valued he valued Uber. He valued very very interesting ways to think about things. But Angelo and Carlos, the funny thing is among value investors, I asked this to Monish Pabray, Dando investor, one famous value investor. Does he know Damodaran? Yeah, he said he knows Damodaran, but he hasn't read Damodaran. So I also asked Whitney Tilson. I asked him personally. When I went to the US, I asked him, how come value investors never discuss about Damodaran? He doesn't know who Damodaran is. So you see, there's really this kind of philosophical divide that that makes us not one, but it would only do if you're a serious investor. Aswat Damodaran has interesting ways, has interesting points that challenges our thinking on value investing. So here, what is an investment philosophy? In essence, investment philosophy are your assumptions on how markets work. Are your beliefs and assumptions on how markets work. Okay? Is market efficient? Is market smart? Because remember this, by the way, I always tell my student, every time you make a buy decision, you are arrogant. You are arrogant. All of you are arrogant. I am arrogant. Why? Every time you're making a buy decision, you're basically telling the market that I know something you don't. I am, or else why are you doing it? That I am on the right side of the trade. You have not factored that in. Remember that. Every time you make a buy decision, there is an assumption, or else don't do it, that you have an edge. You know something that the rest of the market don't. So when I say invest in single name stocks. I'm not talking about index investing. Now, if you think that market is stupid, then that's a very dangerous assumption. Because my view is this: markets are super smart. Market is efficient, not always, but mostly efficient. So that's number one. What is your view of the market? Number two, how do humans, investors, behave? Are they always rational, like what the Homo economicus, the economic textbooks tell us? Are they fully rational that they can absorb information? I saw in the intro slide that you invited the father of behavioral finance or behavioral finance. We know if you've read Daniel Kahneman's Thinking Fast and Slow, if you read this work, and from recent, no, not recent actually, but Richard Taylor, we know that it's not true. Humans are not. So for those of you who studied economics, the Homo economicus, who's always rational, captures all information quite fast, no friction cost, blah blah. Those are not real human beings. Okay, because why? Why do you need to have these assumptions? Because it's only when market market is not on their toes, or humans are not on their, or humans, no, the general investors, falter. That's only how you make money. That's only how you can make money, if you excess money on top of or outperform the market. Okay, so that's why it's very important for you to have a concrete and clear definition of your investment philosophy. And another reason why you should have investment philosophy, your own investment philosophy, is this: things can change. The strategies that used to work will no longer work. So if you don't have a coherent philosophy, the latest marketer, okay, or the latest social media posts will influence how you invest. So be sure that before you invest, come up with a strong definition of investment philosophy. Ray Dalio, another favorite author and hedge fund manager and thinker, said that you should clearly write your investment philosophy. Okay, so to guide you when markets are changing. So again, in the beginning, I always start my value investing class with this statement: understand, in the beginning is the market. Have a view on the market. Is the market efficient? If the market is not efficient, then it's easy. How do you make money? Where during periods of inefficiencies, either you buy or sell. If markets are efficient, what is the consequence? Value and price is one. It's always one. Again, if markets are efficient, value investing, don't bother. Growth investing, don't bother. Because market efficiency, for those of you who took a CFA exam, simple concept, that the transmission of information, okay, is so fast that you cannot, transmission of information to prices is so fast that you cannot act on it. Whatever the value of the company is already reflected in the price. Now, if this is your view, again, my advice is to be humble. Start with the assumption that markets are efficient unless proven otherwise. Because why? There are many motivated individuals who want to make money. So Rob, and of course the asset managers, Chris. So most of you here many of you here are motivated to make money, and you're very smart. You conduct due diligence, everything. So therefore, it's a good presumption that markets are efficient, to have this humble mindset, unless proven otherwise. Now, if markets are efficient, so I will not discuss this. It implies one thing: if you think that markets are efficient, or at least mostly efficient, just buy the market. Okay, so as what one of the by the way, for those of you who are just starting in investing, before you even study value investing, please read this book. Very, very important and powerful book, The Little Book of Common Sense Investing. Because it starts with the presumption that markets are efficient unless proven otherwise. So therefore, read this book first. Because I want you to be the only time that I would encourage you to move beyond this book is if you're convinced that maybe some of the things that this book says is not true in the Singapore context, in the Philippine context, in Malaysia context, or in other markets. So if the view is market is efficient, so simple. Don't look for the needle in the haystack. Buy the haystack, buy the market. Okay? So your goal is just to diversify and pay the lowest possible cost. That's it, indexing. Okay? Now, again, I will not discuss this. Let me proceed to the next part. So we discussed value investing as a philosophy. That is a scientific structure. It can be analyzed, but the objective is boring, defensive, safety of principal, and relatively and reasonable return objective. Now, What is now? I started this discussion of framework with a discussion with a call, no, for you to define your own philosophy. And philosophy is nothing but a set of coherent assumptions on how the market works and how people behave. Now, these are the three assumptions or features of value investing. Three things only. Three things. You read all this in security analysis in Intelligent Investor. It boils down into these three basic principles. Number one, that all financial assets have what you call an intrinsic value. Okay? That they have an underlying fundamental economic value that can be quantified. Number two, that Mr. Market, meaning the market, is not always rational. Sometimes he is moody. Sometimes he is angry. Sometimes he is sad. Sometimes he is too optimistic. And therefore, because of this, you have to have margin of safety. Now, let me go through this one by one because this is important. So what is intrinsic value? So intrinsic value simply means this, that an asset, okay, especially as that an asset has an inherent value. Okay, so for example, when you're talking about properties, the inherent value of properties is what? The cash flow that it will generate, the rental income, or stocks. That stocks are nothing but ownership stakes on businesses that generate income. So from this book, The Theory of Investment Value by John Burr Williams, he said, "What would men do if they're perfectly rational and self-seeking?" The answer is this: when rational man, when they buy stocks and bonds, they would never pay more than the present worth of the future dividends or future coupons. So essentially, what they're saying is an instrument, an asset, is nothing. It's just a paper, but it's nothing but what? But a commitment to what? Or a promise, or not a commitment, sorry, a promise to what? To receive future streams of income, future streams of cash. That the intrinsic value of any asset is nothing but the present value of all its future cash flows. That's it. That's it. So this is the first assumption. Okay, so if you think about it, let's say a lemonade business is nothing but what? Expected cash flows discounted to today. Okay, you may have some views, no, on so by the way, this is Howard Marks. So what he's saying is this: what distinguishes value investing from other type of investing is this belief. Okay, I'm saying belief because I don't want to be moralistic, that there is an objective standard of value. Right? So for example, let me tell you why. So I know a friend here because I also have some crypto, but I don't. But only for but not for investment. More for so for me to understand a small but now it's no longer small. But I don't act. It's not. It's part of my 10. I'll discuss with you what my portfolio management philosophy is. I adopt this 90-10% barbell strategy by Nassim Taleb, discussed in his book Anti-Fragile. So it's part of my 10%, my speculative portfolio. Because so according to Howard Marks, okay, investments or financial assets have an objective standard of value. What does that mean? That you have a basis to say whether it's high or low. So for example, as what I said, let's say we're talking about cryptocurrency. Is it high or low now? Is it high or low? We don't know, right? Why? It depends on what the people are willing to pay for it. I cannot find, even if I'm a believer of cryptocurrencies, of the technology of but that's what I said. There's no clear way on how you define what's the value of that asset class. So according to Howard Marks, to value investor, an asset is not an ephemeral concept you invest in because you think it's attractive or think others will find it attractive. It is a tangible object that should have an intrinsic value capable of being ascertained. And if it can be bought below its intrinsic value, you might consider to do so. So intelligent investing, value investing is based on this basic presumption that all assets have intrinsic value. So when you talk about companies like Facebook, Google, or whatever companies Apple, It's not about the brand. It's not about the culture. It's not about the people. It's not about human resources, distribution, marketing capability. Ultimately, what value investors say is this. Uh, these are good things. These are factors that you would consider, but would only matter if they will generate earnings. And earnings will only matter if they will ultimately generate cash flow. If they don't generate cash flow above your cost of capital, then that is not a factor that you should consider as intrinsic value. Okay? So now, that's the first part, no, intrinsic value. Now let me go to the next part. So I'll discuss this later. So I'll how in the section on how to apply value investing. Okay. Now, but let me proceed with a quote, no, from Benjamin Graham from the book Security Analysis. Now, if you're thinking about, okay, for those of you, okay, Angelo and Carlos, you know the Modaran. He has a very, very good website and spreadsheet on valuation and investing. Now, the thing is this, value investors, okay, we're not too obsessed about valuation as how CFA and the Modaran defines it. Okay, so I'll discuss why. And that is the distinguishing feature of value investing. The essential point, according to Benjamin Graham, of security analysis is that we don't exactly want to know what the intrinsic value of a security is. It only needs to establish either that the value is adequate to protect a bond or to justify a stock purchase, or else that the value is considerably higher or considerably lower than the market price. For such purposes, okay, listen to this, because I think it's a common mistake for new value investors to want to be very, very precise, no, in valuation. For such purposes, indefinite and approximate measure of intrinsic value may be sufficient. Wow. So I studied CFA. I was trained as an economist and an accountant. So as an accountant, every cent matters, especially at least on an accounting, an academic context. And yeah, this is very different. When I studied corporate finance, financial management, this is very different. There, what we are taught is how to come up with, discounted cash flow, estimated cash flow, forecasts. Okay? That I have to come up with one number. No, Benjamin Graham said this: I don't need one number. I don't need a precise intrinsic value. Okay, later I'll discuss with you what is different with value investing. According to Benjamin Graham, to use a homely simile, it is quite possible to decide by introspection that the woman is old enough to vote without knowing her age, or that a man is heavier than he should be without knowing what his exact weight is. Wow. So here, valuation in value investing is not valuation. Intrinsic value is not valuation. It's focusing on something else in making easy decisions. What you need is an approximate. And how do we come up with an approximate? It's very different from the Modaran. I will discuss later. Okay. So two things that I would like to highlight here. Number one, in intrinsic value, you have to have a standard measure of value. Okay. But here, it's not a precise measure of value. It's a range of estimate. It's a range of estimate, and it's an approximate measure. Because this is not the focus. The common misconception is of a value investor is, they buy security analysis, intelligent investor, the Modaran, started studying valuation. No, I will tell you that is the first and easy step in value investing. Later, I will discuss. Okay, so just stay with me just believe me for the moment that intrinsic value is not the same as the valuation that we know. It's just one of the variables that we consider. Now, the second element. Now, this is important. Okay, you cannot understand value investing without connecting intrinsic value with the second concept, Mr. Market. Okay, now who is this guy? So let me introduce you another person. His name is Mr. Market. So this is from Benjamin Graham's book, The Intelligent Investor. Imagine that in some private business, you have a partner. The partner's name is Mr. Market. And yeah, you won a small share that costs you $1,000. Mr. Market is very obliging. He tells you this. Every day he tells you that what the worth of your investment is. Okay, so you can buy and you can sell from him. Okay, he's very obliging. Okay, you can buy and sell. You can buy more share. You can sell your existing share. You can buy more shares from Mr. Market. Now, so this is Mr. Market. Okay, so you can buy $1,000, but there's something wrong with Mr. Market. But before we discuss that, okay, so maybe I'll discuss that now. But there's one problem with Mr. Market. He's very moody. Sometimes he's happy. So if he's happy, maybe your one share will be 5,000. Sometimes he's sad or angry or fearful. Then that would be 500 or 20. Okay? So he's a very moody guy. Sometimes happy and sometimes sad, or sometimes optimistic and sometimes fearful. Now, before we dig in deeper to Mr. Market, let me discuss. Let's because I think I've been speaking for more than an hour already. Okay, so here let's play a simple game. Okay, so please participate. Please participate. We have 16 participants here. So I have a simple question. We have $1 here. Okay, $1. How much are you willing to bid for this $1? Let's say, how much are you willing to bid for this $1? So can you type in the chat? There's no right or wrong answer. Please type 0.98, $1. Now, I will sign this. Now here, I will sign this $1, and then there's a surprise. Yeah, I will sign this. 50 cents. Okay, so here, $1. Who else? So 99 cents. The highest bidder will win a prize. Okay, so I will sign this $1 and then give it to you, mail it to you. Okay, Shaina, thank you. $2. Now, can anyone try to outbid Shana May? $2. So anyone? 2.01. Okay, let's make this faster. Where's your risk appetite? By the way, just bid higher. If your bid is lower, don't bid. $3. Leslie, very good. Leslie. Who else? Who wants to bid more? $5. Okay, 2TW33 2XJ. Okay, hard to read, just TW. $10. Very good. Rose. Wow, very smart, Rose. Leslie, $15. Thank you. No, don't bother to bid if it's lower than the last one. Who can bid higher than Leslie? 18. Carlos, very good. No, not by Munger, only by me. I'm sorry. Cannot be by Munger. By the way, I have a signed book by Munger and I paid, sorry. No, not by Warren, just by me. Am I not enough? Salve. Just kidding. So 25, Shana. Okay, $50. Okay, Salve is still $50. Okay, so I'm closing now. I'm closing the bid again. It will be signed by me. Or by the way, my cat's name is Warren. So there's also a picture. So that would Salve 50. So yeah, that would be with the picture of my cat Warren. Okay, Shana 25. And maybe who's the next highest bidder? Anyone else? Okay, so okay, Shana and Sandino, please stay there because I will I will invite you to a free course, okay, on value investing, which I will call whoever is either one of you, either Shana or Sandino. So the rest, stop typing on the chat. So I would like to talk to you, Shana and Sandino. So I want you to play the game of the century. The price is simple. You'll get a free. So I'll give you some good reading materials, and then you'll get a free access to my value investing course. But here, I want you to play a new game. So again, bid between the two of you. Come up with the bid. The highest bidder wins. Now, there's another catch. Okay, if you are the second winner, if you lose this game, I will ask you to pay $100. Okay, I will ask you to pay me $100. But if you win this game, I'll give you $1 plus free access to my course on value investing. Now, Shana and Sandino. So I'll start with Sandino. How much is your bid? Cannot be lower than 25 than 19. Huh? So Sandino, how much will you bid for this $1? Type in the chat. Sandino Maranan. So the price is a free access to my course, to my 3-day or 5-day course on value investing. Sandino, are you still there? Wait, sorry, I cannot see the. Oh, sorry, you're typing. Sorry, there's a bit of a lag. Okay, thank you, Sandino. 99. Okay, Shana. Good, 100. Sandino, come on. Come on. Free access to the course, free books, and $1. Signed and then signed by me. With a photo of my cat, Warren. 105. Shana. Go. How much will you bid for this? Very precious. Shana, it's one. Sandino, Shana said 110. Can you bid for more? Let's just end this. Can we be faster? Don't make in increments of 10 and 20. The fundamental value or whatever value this dollar is very, very high. Yes, thank you, Shana. Sandino, let's just end this game. 220, okay. Let's end this game. So now, last bid. Okay, so think about it, Shana. Think about it. This is the last bid. I'm giving you a chance. Unfortunately, Sandino can counter you. So how much will you bid for this? Oh, sorry. There's a lag. Shana. Thank you. 350. Sandino. Sandino. Okay, good. Okay, now we end this game. Now, so here, everyone, look at what just happened. This is a simple game that I always go. In fact, in the last class, someone in the last class, the Ateneo webinar, someone I think the highest bid is, if I'm not mistaken, $10,000. Of course, they wouldn't pay that, but yeah, but in a live class where there's a genuine risk, that someone will pay. So I conducted this live in Malaysia, and yeah, although I didn't enforce it, but I kind of pretended that I would enforce it. Someone bid $500. Okay, prepared to pay $500. So what did we discover about ourselves here? Because here, the reason why I want to play this game, because this tells you an important, very, very important lesson in investing. Number one, that in this simple game, $1, the intrinsic value is simple, $1. You started out rational, 0.98. Someone kuripot, very good. A value investor is kuripot. We are bargain hunters. So many of my books are second-hand books. I'm a bargain hunter. So as a bargain hunter, you start with 50 cents. But what happened? Are you stupid people? No, we are not stupid people. But when I first played this game under one of my great value investing teacher, yeah, I also bid that because he said he will sign it. Yeah, so I said, yeah, of course. I want it for $50, $100. So look, what happened here is very dangerous. Why? Mr. Market is a very dangerous guy. Mr. Market is very persuasive, not only moody, but very persuasive. Sandino, Shana, and all of you, this is nothing. In fact, you're more rational, just $400. But you see, in an instrument that at the end of the day, you will get no more than $1. Okay? Even if I sign it, no one will buy it for more than $1. But some of you, many of you, posted a bid at 400, 300 at valuations that cannot be justified by intrinsic value. What more on stocks? I'm recently reading this book by Aswat Damodaran, a good book, Numbers and Narratives. Very good book if you're an investor. So he's saying if you're not if you don't protect yourself against the storytellers, people who tell stories about certain stocks, certain asset class, you will lose money, because not only Mr. Market is moody. Mr. Market is a dangerous guy because he will compel you to act. He will give this incentive for you to act. So here, now what is the role of intrinsic value? Intrinsic value grounds you. Intrinsic value grounds you. Okay? Intrinsic value tells you, okay, maybe think twice. Okay, so you may think that, I will be a famous guy someday. or the course is worth whatever. But no, if you have $1 in mind, okay, I may overpay, but then definitely not X amount, not more than X amount. So intrinsic value is something that will ground you. The interaction between intrinsic value and Mr. Market is simple. Intrinsic value is a value investor's shield. It's our weapon against a dangerous Mr. Market. As what I said, Benjamin Graham started the value investing philosophy in an environment where investing is dangerous. So intrinsic value is our first level of defense. That's why the first step in value investing, other than the searching part, is to what? Come up with a valuation. But I will discuss it's different from the traditional corporate finance valuation. A single simple dollar cannot be worth more than $1. Okay, so where will we make money? Warren Buffett's other famous quote is this: be greedy when others are fearful, be fearful when others are greedy. How do you get this conviction to be greedy? So I invested, so I'm very happy. So I was just talking to my wife. So we invested a significant amount of our portfolio late last year, March. So I flew to Malaysia. So I have this weekend lectures in Malaysia. So what I would do is Friday night, I would invest in stocks. I would analyze companies over the weekends and sometimes nighttime on weekdays. So by the way, now I'm only investing almost exclusively on Chinese and US shares, not because I don't believe in Philippine shares, but because I have a daytime job. I work for a bank, and yeah, I only have time to execute trades at nighttime. So yeah, so that's what I do. So nighttime, so I remember those times, Feb and March, there's a lot of noises about, the world is ending. So in fact, no, I spoke to one trader who I respect, very well-known trader in the market, very risk taker. He told me this: the world is ending, the world is melting, it cannot be solved. This is worse than the 2008 financial crisis. Now, given that I have been preparing for this moment, for that moment, so I know it sounds bad, but at that moment, preparing to take advantage of, so that's a time when I invest significant. I'm very happy, with the results. That's how. And in Philippines, when I first invested during 08 and 09. 08 and 09. Then so if you're a value investor, by the way, one of the clue that you're a closet or a value investor is this: if markets is down, are you agitated to act, or you're more agitated to act when markets are up? Fear of missing out, or fear of if you're more agitated, fear of missing out, then you're more of a momentum investor. Okay, buy high and sell higher. Okay, the trend is your friend. Now, if you're a value investor, especially if you're not fully invested, so a lot of times I would hear people who are not invested in the stock market who say, no, I'm scared of the market. It's melting. It's going down. Wrong. Why will you be scared? You're not fully invested. You should not be scared. In fact, this is the time to act. Especially if you believe in mean reversion. Although there's some arguments against that, but my point is, your odds are higher. Right? Your odds are higher if you invest. When Mr. Market is pessimistic than when Mr. Market is optimistic. If you are a value investor. Now, if you're not a value investor, then you will be more fearful. If markets keep on going up because you're missing out. Now, so here, there's a problem. For those of you CFA and those of you who are who are equity analysts, who are fundamental analysts, you know that valuation is a biased process. So frequently, people there's a common misconception that because it's numbers, it's precise, it's quantitative, that it's not subject to bias. Wrong, very wrong. So usually in the valuation process, in the data collection, in the performance of the valuation process, even in the presentation of your valuation, there's always a bias. So when you talk about Elon Musk, Tesla, when you talk about Apple, there's certain emotions that are embedded there, and you will never be objective, even if you are the most thorough valuation analyst or security analyst. There are many uncertainties in valuation. When I conduct valuation or value investing classes. If let's say I ask my class, oh, can you value this company? And if they give me a single number, I will fail them. Okay, because they don't know what valuation is. Their valuation is never a precise, it's never a precise activity, right? Because why? There are many uncertainties in valuation. Okay, while you can identify the core earnings or the sustainable earnings of a company, it may decline. Okay, the terminal value, which is usually the most sensitive in terms of valuation, your discount rate is not precise. It's all subject to bias or it's all subject to assumptions and bias. So there are many uncertainties. This is why the third element is the most important part of value investing. And it is the quality of humility, margin of safety. According to Benjamin Graham, he wrote thousands of pages of books and articles. And he said this. He was forced to distill all his investment wisdom. And he said this, the three most important word on investing is margin of safety. Seth Klarman, one of my favorite value investors, said this, a margin of safety is necessary because valuation is an imprecise art. The future is unpredictable and investors are human and do make mistakes. You have biases. Okay? You have biases. By the way, if you want Seth Klarman's book, so I'm also including this as part of the canon of value investing books that I'd like to explore. It's one of the most expensive books. If I'm not mistaken, it's selling for thousands of dollars, and it's already out of print. So I have a copy. If you're interested, let me know. Okay. So value investing is an engineering concept. It's about building safety upon safety upon safety. Redundancy. It's based on this concept in engineering called redundancy. Why? Because I'll tell you why. So I'm teaching risk management. I wrote a 2-volume book on risk management. But you know what? I changed. 10 years after I wrote that book, I no longer believe in whatever I said in that book. No. Before you judge me, the reason why I wrote that book, because I'm in a banking context. In banking, we have this regulatory framework called Basel. We have no choice. Okay? Basel prescribes certain minimum standards on risk management practices. Okay? And these standards tend to be probabilistic. Now, I'm a fan of Nassim Taleb, the author of Black Swan, Fooled by Randomness, Anti-Fragile, and Skin in the Game, the Inserto series. So he said, he convinced me, so those books there, he convinced me that the world, we have to be humble. The world is not predictive. No one can predict. I remember, sorry, can you hear me? So I see, okay. Can you hear me? So I'm seeing some, oh, thank you. Okay. So when you, so there is this human bias that when we see a complex model, complex number, value at risk, Monte Carlo simulation, that we tend to think that because it's complicated, it must be correct. Wrong. Very, very wrong. Avoid that mistake. Investing, especially if it's about the future, is not knowable. Future is not knowable. I'm adopting a non-predictive view of the world. I am a humble person. I think that I don't know many things about how the world works. So I'll tell you a very humbling experience. So late last year, so I was, as I said, I'm a derivative structurer. So I was presenting to some clients about where rates will go. So I cited fundamental forecasts from our own in-house economists. So what they're saying is economies go historic high uninterrupted, despite the trade war, and especially with the resolution, the phase 1 trade war between US and China, nothing can go wrong. Nothing can go wrong. Trump will win re-election, market-friendly policy. Therefore, rates will be above 2%. Wow. In February, a thing called coronavirus changed everything. So you see, the thing that I'd like to highlight is this. If there's one thing that you can learn from this webinar is this: be humble. The world is not predictive. And if you adopt that mindset, then you will change your decision very differently. Decision-making criteria very differently. You will build redundancy upon redundancy, margin of safety. Margin of safety. So as Warren Buffett described it best, you leave an enormous margin of safety. What does that mean? Look at this picture. You build a bridge that 30,000-pound trucks can go across, and then you drive 10,000-pound trucks across it. That is the way I like to go across bridges. So build bridges that last, that can withstand 30,000, but take only 10,000-pound risk. Now, there's a consequence. One main consequence is this: because this is a very defensive investment strategy, you will miss out on many good investment opportunities, great investment opportunities. Okay? But again, that's a consequence that a value investor, I think, is prepared to accept. Because again, the overriding objective is what? Safety of principal and reasonable return. I am not looking at outperforming the market, because I have at least on my portfolio, my main priority is safety of principal. So the philosophy of value investors is think about the risk and the return will take care of itself. Okay, but there again, this is also one of the main sources of criticism, main criticism against value investing. And here, I will show you why. So to show you that do not believe in value investing as a gospel truth, because why? Things change. And this is one reason. It's not because so some people derisively call value investing as obsolete, useless. That's not true. That's not true. It may be obsolete at this time, but then, so I will discuss that things evolve, and our understanding of value could expand. But at that time, this is a very valid investment philosophy. So I'll show you this. One case from the security analysis in 1922, a company called Wright Aeronautical Corporation is selling at $8. This company is paying dividend of 1 per share, earnings of 2 per share, but it has a cash per share of 8 per share and almost no liability. So look at this. This is the reverse of our dollar bidding game a while ago. In this case, intrinsic value, just look at the cash, 8 per share. 8 per share. It's selling at 8 also per share. This one is a no-brainer decision. In fact, it's one of the cases that was cited in security analysis. At that time, so here, I want us to, maybe I'm front-running my discussion, but let me discuss this. The reason why value investing, as defined by Benjamin Graham, no longer works is this. It was so good. And Benjamin Graham is a very selfless individual. There's a strong tradition of teaching and value investing. He shared his investment strategy. In fact, in his classes, every time he conducts his classes, people will often excuse themselves because as soon as he mentioned a stock, a share, they will immediately buy that share or short sell that share, whatever the case is. Okay. It becomes so good because he was so selfless in sharing his knowledge, becomes so good that the opportunity, because markets are efficient, market is intelligent, practically disappeared. Although that's not true. Last year I found some good, but these are small companies. I found some good opportunities during the pandemic. Now, so the story is this: I can buy a company. I can buy $1 for 1 centavos. I can buy $1 for 5 centavos. So that's a simple story. Okay. So Warren Buffett also, when he bought Washington Post, the intrinsic value is 400 to 500 million. But then there was a time when Mr. Market said, "Oh, I'm very pessimistic about newspaper," because at that time, President Richard Nixon, I think because of the Watergate or the events leading up to, I think they published a Pentagon Papers, if I'm not mistaken. President Richard Nixon, like what was done to Inquirer, I think before, if I'm not mistaken, during President Arab's time. So what happened was he started to kind of publicly humiliate Washington Post. The stock price went to as low as $100 million. So Buffett bought it, and so he became one of the largest shareholders of Washington Post. Worked well with Katharine Graham, a legendary CEO of Washington Post. And in 2014, Buffett sold his stake. on top of the dividends that he received, stock buybacks and the dividends that he received from Washington Post, he sold the 10.6 million stake to Jeff Bezos for $1.1 billion. Okay? So that is the framework of value investing. Intrinsic value, that securities, assets are not just pieces of paper, but represents claims to future cash flows. That's intrinsic value. But where do you make money, Mr. Market? Sometimes irrational. Again, it's important that you assume that markets can be irrational at times, or else don't bother with value investing. And number three, I can be wrong, and therefore I apply a margin of safety. When I went to Charlie Munger 2 years ago, when I went to this daily journal meeting, he mentioned to me this guy, Lilu. He's a famous value investor. Not many of you know. In fact, I asked my colleagues in China, in Shanghai, they don't know him, but he's one of the smartest value investors of our time. And his story is inspiring. I will discuss that later. So he had this interesting concept where he said this. I will tell you this, if you're a value investor, the stock market is not made for you. Stock market is not made for you. The stock market is made for the 95% of the people. So that's why I have friends now, they want to make quick money. If you want to make quick money, value investing is not for you. The stock market is made for the 95% of the people who want to trade on the markets, who has the appetite, or whatever, or maybe unique insights, who want to follow the market. Market is made for them. For the 5% of us, who are value investors, it's not made for us. It's not made for us. Which is why, knowing this, there are many things that you should change in your investment process, knowing that fact. For example, to me, the tycoons, the Taipans, for example, Gokong is a good value investor. When he bought Meralco, he bought it at a very good price. The intrinsic value, but you see, Mr. Gokongwei, I don't think he looks at at that time before he sold his Meralco stake. I don't think he looks at the market value of the stock on a daily basis. Same, because the stock market is not made for value investors. So if you want to make money, to outsmart the market on a short-term basis, then value investing is not for us, for you. Okay. So here, but then something has changed. Okay. I will tell you the main sickness of value investing is that we believe that that there's an objective standard of value and are attracted to low valuation. And as what I said, it used to work. It used to work. Now, then there's a problem. It started to not to work. The good quality classic Benjamin Graham below liquidation value investment no longer works. Right? So for example, Warren Buffett bought this company, a textile company called Berkshire Hathaway. That's the name of his company now. But did you know, for those of you who are not following Warren Buffett, it's a failure. Berkshire Hathaway is a failure. That's why he bought a National Indemnity and various other insurance companies. Why? Because he lost so much money on Berkshire Hathaway. Okay? He lost so much money on Berkshire Hathaway. The textile company, the textile industry is under threat from China and from many other low-cost producers. So he has to shut this down. He bought this. Look, the price per share is 7 per share, but the working capital per share is at 22 per share. Wow, classic Benjamin Graham opportunity, and he lost money. It's a bad investment, and he sees this. The funny thing is, his greatest success is also his greatest mistake, and he says that. Okay, so there's a problem. That's why he started out investing in a partnership format called Buffett Partnership Limited. By the way, if you're interested on Buffett's early years, read this book, Ground Rules. So this is about his early partnership years. For a small-time investor, this is more relevant than the recent letters that he is writing, the partnership letters. Snowball is a good book. Yeah, very good book. But yeah, he doesn't like it for very obvious reason. Because he revealed, I think Ali Schroeder revealed so much, gossipy stuff, right? But it's a good book. I like that book also. Yeah. So wait. So here. So listen. it started to not to work. In fact, that was when, yeah, it's a very revealing book. I love that book. It's one of my my favorite books. It started this midlife. Yeah. Oh wow. So it started this midlife crisis. I agree. It's like our Harry Potter, or maybe Captain Underpants, because I think so. It's one of the banned books because Warren Buffett hated it so much. Okay, so here it started the midlife crisis on the part of Warren Buffett. In fact, he said there's no more opportunity. He returned money. So you see the integrity of this guy. He could have kept the money, but he returned money, investors. And if you want, yeah, then continue. But he returned his money and asked and recommended another fund manager, Bill Ruane, to invest that money because he can no longer find any opportunity. So for the longest time, he cannot get out of this almost ideological influence of Benjamin Graham. John Maynard Keynes said, the difficulty lies so much not in developing new ideas, but in escaping old ones. Very powerful quote. Remember this. We all have these old ideas, almost a religion in our mind that we cannot overcome. And this is what is stopping us from progressing further, especially in a changing world now. And someone came, Charlie Munger, his partner. Charlie Munger opened his eyes and said, Warren Buffett, if you want to scale your investment, you have to abandon the principles, many of the principles that you learned from Benjamin Graham. Because why? One problem, by the way, I forgot to tell you, and I'm writing a book on this, and conducting a research and writing a book on this. One of the problems, the Benjamin Graham style of investing, is you might get what you call a value trap. So meaning it looks like a good value, but actually value could deteriorate further because of management incompetence or because of structural shifts in the industry. So be very careful. So for many of you who want to apply, yes, agree, Pat. Yeah, but Pat, if you recall, he started out speculating on FX and commodities, right? But yeah, he eventually became a more value event. That's a good point. Keynes is a great investor, to study, especially the later years. Although I was surprised that you like him, given that our Austrian orientation. Anyway, yeah, but I like him as an investor. Thank you for that, Pat. So here, Charlie Munger introduced Warren Buffett to this guy named Philip Fisher. Also a great book. Great books, wrote these great books, Common Stocks and Uncommon Profits and Paths to Wealth and Through Common Stocks. So what Philip Fisher taught Warren Buffett is to escape, and Charlie Munger, is to escape that paradigm, that the only good investments are good investment with low valuation, as defined by accounting, low price book to value, low price to earnings. You should look further. You should be less quantitative and look for qualitative aspects. So Charlie Munger said that it's easier to make money from thank you. No, I'm joking. Okay. Yeah, Kelly typed that. So Philip Fisher said, no, stop looking at pure value plays. Stop looking at cheap stocks. Start looking for quality investing. So look for wonderful companies at fair price. So it used to be from cigar butt investing or the Benjamin Graham style of investing, where Warren Buffett could buy a very ugly, bad company. Maybe bad company, I don't care, as long as I buy it at the right price. He shifted his thinking. Bad companies, they tend to be smaller than good companies. That's generally true. And second, they tend to bad companies tend to take time before you realize value. So why? So in some of the Dempster Mill and some of the investments of Warren Buffett, he has to fire people in order to realize value. So for example, I'll tell you one example. I found this value trap. So I encountered this value trap in my own investment journey. So I invested in this company trading at less than cash per share. So what's the common danger for Benjamin Graham style of investing? You think it's cheap, but the problem is this: for that to be cheap, you have to what? For example, you find a share that's trading at 1 per share. They have a cash that's they have a cash in their balance sheet that's at 10 per share. If you have a bad management controlled by bad board of directors, can you actually sell and liquidate the company and realize that 10 per share value? No. There are companies, right? Usually bad management who want to continue to operate even if they are earning less than their cost of capital. Bad management may stop you from realizing value. Now, you can be an activist investor like Bill Ackman, but it will take a lot of energy and effort for you to realize value, and therefore it's not scalable. And by the way, one of the reasons why I like value investing is because it gives me peace of mind. That's one. And second, value investors tend to, our horizon tend to be longer term than the rest. So then I don't have to worry on a day-to-day basis. So according to Warren Buffett, which he learned from Philip Fisher, these are very good books. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So the paradigm has shifted. In fact, they're saying Philip Fisher is not a value investor. He's a growth investor. So therefore, in fact, he's the patron saint of growth investor together with a T. Rowe Price. Okay. So according to Warren Buffett, investing is most intelligent. Benjamin Graham also said it when it is most business-like. So you invest like Mr. John Gokongwei, you invest like MVP, you invest like the tycoons, like business owners. Okay, we don't invest for short term. We think of this paper not as securities, but as what? As a business, as a fractional ownership of a business. And therefore, if you're thinking like a businessman, so Lilu has this interesting exercise. How do you approach investment? Imagine you have a rich auntie. Okay? If you have a rich auntie, then yes, she has no heir. So what she did is, I give you this company that I run for a very, very long time. So what are the questions that you will ask to the management who's running this company? That mindset, a business owner mindset. You think like a Walmart, like the Walmarts, how they approach the Walmart. You don't care about prices. What you care about is this. Is this a wonderful company? And what is a wonderful company? A wonderful company is a company that has great business characteristics, growth, high profit margin, return on capital, competitive advantage. And what? Good management, integrity, conservative accounting, can adapt to change. Now wait. Benjamin Graham is the first quantitative investor. He's a quant. In fact, if you read security analysis, he doesn't want to meet with management. He doesn't want to interview management. What he thinks is analysis is enough. Oh, now our job is more difficult. Warren Buffett made it difficult. Warren Buffett expanded the definition of value. Okay? So now I will look for wonderful companies. Okay? Even if they're not cheap, as long as they're trading at fair prices, I'm okay. But then how do you know it's a wonderful company? You have to be more holistic. You cannot just look at the financials. You have to understand the business. So he always say this. It took him 10 to 15 years before he invested in Coca-Cola. It took him decades before he invested in Apple, because he's adopting this business mindset. You look at competitive advantage, competitive strategy, Michael Porter stuff. Okay, so not just reading the balance sheet, but you really have to understand the business. You have to What is a wonderful company? Wonderful company is this. The more companies like See's Candies, Coca-Cola, these are Berkshire companies, said this. The most important thing is trying to find a business with wide and long-lasting moat, like a castle, a defense, protecting an economic castle with an honest lord, a great management in charge of the castle. Okay, now, by definition, wonderful companies are exceptional and hard to find. And therefore, How will it change your investing? This is the most controversial conclusion of the Philip Fisher style of investing. In fact, it's not just about wonderful company, it's also how you approach risk management. So what he said is this. Again, this is not for everyone because here, again, the main premise is you have a business mindset. You really understand the business. You can talk to management. You can interview management. You have friends. You have superior information as long as it's not in or insight. Sorry, not information. Superior insight. Given how hard it is to find a wonderful company, how would you change your approach? Benjamin Graham said, given that investing is dangerous, his risk management strategy is simple: diversify. Because remember, you buy cheap, some will be a value trap, some will be a success. So what you're relying on is a statistical concept called mean reversion, that everything will be eventually come up. Okay, so his philosophy is just diversify. Philip Fisher said this: no, because you're adopting a business owner mindset. You will look at this company thoroughly, study this for many, many years, develop a unique insight. You would change your investing approach from diversification to focus investing. Okay? So if Benjamin Graham said, don't spread all your eggs in one basket, the approach of Fisher Black, Fisher Black, sorry, that's a different so the approach of Philip Fisher is this: do not diversify, focus on watching the basket. Okay, so owning a few outstanding companies is better than owning a large number of average ones. This is not for everyone, because the main premise is you will have extraordinary effort, extraordinary insight. If you don't have this edge, diversification, you have to diversify. That's why I said read Jack Bogle first, before you go to this. This is the next level. So Charlie Munger said this: our investment style has been given a name, focus investing, which implies 10 holdings, not 100 or 400. So by the way, two of the books that you should read if you want to understand the philosophy. This is a very popular book, The Warren Buffett Way by Robert Hagstrom. Very great guy, also a good writer. So I like this book. If you're a beginner, read this book. I will. But if you want to understand their portfolio management philosophy, the focus investing, and you don't want to read the Philip Fisher book, read this book, The Warren Buffett Portfolio also by Robert Hagstrom. Okay? So this implies holding only 10 securities. So this is, by the way, is the billionaire way of approaching investing. If you think about it, whether you talk about Mokhtar Riyadi of Indonesia, Salim of Indonesia, who else? Ayala. They're not, they don't have they have 500 entities, but these are not 500 companies. They're generally focused on few companies. So the Philip Graham approach and the Charlie Munger approach is a tycoon-like approach. Okay, so according to Philip Fisher, blindly diversifying is dangerous. Okay, you can diversify, but if you diversify blindly, it's as risky. So to him, this is game changing. To him, the risk management is not about the Markowitz style 1/n kind of investing. It's about focusing on enhancing, on learning a lot, developing that superior insight such that it will give you the confidence to invest or bet big. Okay? So Andrew Carnegie said it best: the way to become rich is to put all your eggs in one basket. Wow, contrarian. Very, very contrary to popular view on investment risk, and then watch that basket. Okay, so what's the most effective risk management? So the reason why, because as I said, I specialize in quantitative risk management. I started my career there. I wrote a book on risk management, and I have this complicated models: expected shortfall, value at risk, stress testing, All those models. That's why it's hard for me when I first read about Warren Buffett in this, Salve, I think you mentioned Alice Schroeder. Another good book is a Roger Lowenstein biography of Warren Buffett. When I read that book, I said, wow, he's so primitive in his risk management. Why? His risk management is very qualitative. So what he said is this: the appropriate risk management is not quantitative diversification, but qualitative knowledge. Learning, as what Rob discussed early part of this in his introduction, to understand your circle of competence, to be very good at something and expand that circle of competence. What you know for sure, what you somehow know, gradually expand this. Now, by the way, this is a common quote from Warren Buffett in Circle of Competence. So Thomas Watson, IBM, said, "I'm no genius, but I'm smart in spots. I stay around the spots." So what is Circle of Competence? It's not just knowing, but knowing what you don't know. So I notice when I talk to experts, let's say I'm doing derivatives. So I have some expertise on derivatives. To have some expertise, that circle of competence, you have to know what is not knowable and what is knowable. You have to know the bounds, the territory. It's like North Korea, South Korea kind of boundary, that single line. You have to know the edge. You have to know the questions that you ask about things that you should ask about things that you should know. You have to have these mental filters, 5 or 7 heuristics on what matters. And to do that, you have to spend countless hours studying and deeply understanding the business. That circle of competence, knowing what you know and knowing the boundaries of what you know, meaning things that you don't know. Okay? So my first advice, especially to students here, is I read this short book, very easy read, Investment Ikigai. Ikigai. So I'm calling this the Investment Ikigai. So how do you know what is your circle of competence? How to start finding circle of competence? Find what you love. Find what the world needs. So this is strategy, competitive strategy, understanding the business model. What the company is the company being paid for something? If it's airline, then maybe it will be a bit challenging. Maybe you love traveling, but then airline, what you can be paid for, is the airline industry really earning, even pre-COVID times? I think there was only 2 years, 2 accounting period, where the industry as a whole earned above their cost of capital, and what you are good at. So the intersection, this is a Venn diagram. That intersection is what you should focus on and start with. There are many industries. You can start with whatever, right? Start with, if you are, so I have a student who's good in, because he has a food business. He's good in the food business. So I advise him, start with food, start with Philippines, and then gradually expand. So I remember when I went to the Charlie Munger meeting, so I asked questions 2 years ago, and I asked him, where do you start? And he said this, 2 things: fish where the fish swims, where opportunities are abundant, Philippines, China, and focus on what you know. So when we say that markets are efficient, because the US dominates all the thinking on investment. But when they say that markets are efficient, when they say that all opportunities have already been explored, don't believe that, because you are not investing in the US. You're investing in the Philippines. The thing about investment is this: it's not a purely, you don't have to, how do I say this, to fight where most people fight. You can find your own battleground, where you're good at, what you love. Is that company what you can be paid for, and what the world needs? By the way, this is also applicable even to career. The intersection between passion and what you can commercialize. Okay. And therefore, if wonderful companies are hard to find, if wonderful companies must be studied in a deeper way, rather not just what would change in your approach, you will do. And if it's so rare that you cannot find it, what's the consequence? The consequence is that you should adopt a scuttlebutt approach. What does that mean? You have to do more than more than doing spreadsheet analysis. You really have to go out of your way and ask questions. Look for people you know. So what I normally do in my investments, let's say I'm interested in company X, I will look at the because in the annual report they discuss the competitor, and I will read each of those competitors, And if I know someone working in that company, I will ask them, do you admire your company? Or if not, if you admire your company, who are the competitors that you admire? Then I will study competition. It's about that. It's more than just studying this specific company. It's having this curious mindset, an almost journalistic type. So by the way, I noticed now, so Lilu also said this, most of the great investors are journalists. Many great investors are journalists. Salvi, you're right. Financial journalists know how to scuttlebutt. So therefore, they ask the right questions that, normally finance professionals don't ask. The relevant questions, the curious questions that could, okay, access, So that's also, then you have a good edge. You have a very good edge. So most of the good investors that I know. So I know one from India. He started out as an editor for a newspaper. He's a very, very good investor. He asked questions that, because I have this value investing community in Pune, India. So he asked questions that I would never think of as a finance professional. So that's right. It's a journalistic way, Sherlock Holmes type of approach in investing. And because of that, that's a hard, that is more, thank you, Salve. That's harder than this armchair analysis, quantitative analysis. And here, by the way, as what I said, do not read Warren Buffett quotes and believe it without context, because there's always a context why he said, my favorite holding period is forever. Because Warren Buffett has been reading annual report. Okay, Salve recommended that book, Snowball. I highly recommend. If you look at the intensity, how he studies company, how he ignores his children, which I cannot do, how he just shuts himself down. And he did it, he started very early, 7 years old, 11 years old, reading investment books, reading annual reports, reading full time. That's why he can say, he can hold things for forever, indefinitely. So he borrowed, because Benjamin Graham's horizon is 3 to 5 years, not really forever. Very, very short term, because they're investing in low quality companies. Now, Philip Fisher said, if the job has been done correctly, when a common stock is purchased, the time to sell it is almost never. Okay, now, again, do not make the mistake. Do not be arrogant to say, I believe in Warren Buffett. I will hold this for forever. There's a presumption why you can hold it forever, because you have done your homework and you are confident. You are confident in your understanding. So there's a fine line between arrogance, and conviction. Remember that. So that is the Philip Fisher way. And therefore, what is value investing as a process? Value investing as a process, as what I said, is different. Kawawa. If all. Totoo. That's why. So I started with Interactive Brokers and Saxo when I started when I moved here and we started investing. So I noticed that compare even for some of the private banking accounts, what I noticed is they don't like me. Brokerage don't like me. I'm not a valued customer, so I asked for help because I have a Berkshire share and I want to be accredited as a shareholder so I can fly to Omaha last year. And they don't want to entertain me despite the decent, I think it's a decent size that I placed there compared to other institutional investors. Sorry, not institutional, sorry. Let me correct that. Compared to other retail investors, they don't want me. Oh, sorry. I think someone is can you put it on mute? Okay, so they don't want to entertain me because I don't move much. I rarely sell. I rarely sell, except that coal company and some other companies that I have to sell. But I rarely sell. In fact, selling is a problem for most value investors. Now, what is if you think about it, let's summarize value investing. Value investing is counterintuitive. That's why I want you to be open about this. Because it's not a positive, our brain, there's a lot of behavioral finance or economic studies on this. Our brain is designed to think positively. Of course, there's loss aversion, right? But this is different. I mean, our brain is more receptive to positive messages than negative messages. The problem here is this. Value investing is a negative art. It's about saying no, 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 no. It's a process of elimination. Why? It starts with this basic presumption that we don't know. Okay? So I have an intern now, here based in Singapore, and I was surprised. I asked him. He knows a lot of things about the market. So, for example, I asked him about some stuff about a stock idea, and he's very convinced. So I said, that's a very dangerous thing. If you're starting from a position that you know with no basis, you will lose money. I read countless history, people who lost money because of this. Value investors are on the opposite side, opposite spectrum, not necessarily better. Okay? We are not optimistic people when it comes to investing. Well, in holding, we are more optimistic, but when it comes to approaching investing, we are skeptical. We start with this assertion that we don't know many things. Valuation is an inherently flawed process. And so therefore, the game in investing is to think about risk first, then worry about the return later. So risk, it's protection. It's a process of elimination. So if you read this book, it's a classic, it's not here. It's a classic book, Good to Great, Built to Last, classic business books. So if you read those companies, they are no longer great. So for example, I used to, well, I think for most of you, when I was on university, I admired this manager of the century, Jack Welch. Okay, CEO of General Electric. Yeah, Jim Collins, Carlos. Yes, correct. The Good to Great, very good book, and Built to Last. So General Electric, everyone says it's a great company. If there is one company who I think at that time will live forever, that's General Electric. And then there's a good book now written by Wall Street Journal journalists. I love it. Lights Out. You would see that General Electric, number one, is no longer part of the index, and number two, is perform, although it has recovered quite a bit, but there are concerns, there are issues on going concern on this company. It's very unthinkable for a company as gigantic and as powerful, as well-run as General Electric to suffer this fate. In fact, General Electric is the breeding ground of famous CEOs. The CEO of Home Depot, the Larry Bossidy, the CEO of Honeywell, Allied Signals. So many of the great CEOs came from General Electric. And yet this company, over a short period of time, it's now, people are even wondering whether it can continue to survive as a going concern. But this one, my favorite, Lehman Brothers. I started out, so when I was in university, I targeted two companies because these companies, Bear Stearns and Lehman Brothers. These companies are known to attract people who are PhDs, poor, smart, and driven. So I wanted to join these two companies. I targeted to be there. But by the time I finished my accounting, my CPA, around the time, these companies are close. These companies encounter going concerns issue. Yes, these are, by the way, Salve, Bear Stearns is known to be, especially under Ace Greenberg. In fact, I love Bear Stearns so much that I read a book by Ace Greenberg. If he had been the CEO of Bear Stearns, I don't think this will happen. It's because of Jimmy Kane. But they are very, very sophisticated quantitative risk managers, powerful risk management models, good traders, good risk managers, and yet this happened. So if this company, standard names, Kodak, Kodak, and many other companies encounter this problem, so we have to adopt a simple mindset. Don't think about returns. Don't think about returns first. Think about risk. Okay, risk is the main object, the first and primary objective of good investors. Investing is a negative art from a value investing paradigm. Okay, so the function, according to Benjamin Graham, because the future is not knowable, he encountered this once in a lifetime event, the Great Depression. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. We don't have to forecast. We don't have to forecast. If we have to forecast, it's hard. It's a hard decision to make. Or at least now, you have to compromise now, right? A bit. Okay? You have to forecast as least as you could, okay? Because the world is not predictive. And Charlie Munger had this very, very favorite quote, which I want you to remember. His life motto is this: all I want to know is where I am going to die, so I will never go there. All I want to know is where I'm going to die, so I will never go there. Think about death first and avoid mistakes. So I read all of those, right? Anthony Robbins, Norman Vincent Peale, Jim Rohn, all those positive thinking, success books. Oh, yes, I love that book, Carlos, Against the Gods. Yes, I love this book about mastery of risk. It's one of my favorite books by Peter Bernstein. Yes, good book. Yeah, great. Thank you for that. One of my favorite books. And actually, one of the books I would recommend. Think about risk first. All I want to know is where I'm going to die, so I'll never go there. To understand how to be successful, again, in investing, don't confuse IQ, especially in a bull market. It's not because you're smart. In a bull market, everyone is smart. Okay, so remember that in a bull market, everyone is smart. So I would hear people talk about, thank you, Salve. So I'll recommend some more, especially on the jump starting part. In a bull market, the problem with finance is this. This is the problem with finance. The problem with finance is, as what I told our intern, is that the reckoning is never final. Do you agree? So today I am a genius. Tomorrow I am. So I remembered, when I had this small investment, not investment hedge, because I'm a fan of Jewish history. So I kind of invested in bitcoins. But no, sorry, not invested, but speculated. So I forgive myself. There's a substantial portion of my portfolio, 90% is investing. But as what Morgan Housel, one of my favorite financial writers said, forgive yourself. You can speculate on the 10%. Okay, I'm not a purist, no. So at 10%, I would speculate. That's my hedge. I see that as a hedge. So my wife, I receive all this. My wife nagged me for having some position on Bitcoin. It's one of my losing up invest for the longest time. And now she tells me, oh, why didn't I buy more? You're a genius. But again, in financial markets, nothing is final. So remember that. Be humble. In a bull market now, everyone is a genius. What I have done last year, pandemic, that's why I don't discuss specific investments. Because if I discuss, except for example, Dunkin' Donuts, because I sold that already, because it was bought private, it was taken private. But I don't discuss individual stock investments except to a few trusted, the community. The reason is I don't want to be bound. I don't want you to think that I'm stupid. Hey, Philip invested in stock X. It's a coal company. So stupid. Then I'm compelled to sell that. Okay. So just because it's not popular. Okay. So my point is this. Remember this. Don't confuse stock market performance with your IQ. There's no correlation because the reckoning in markets is never final. Okay? Never final. So therefore, adopt a non-predictive view. You cannot predict. All I want to know is where I'm going to die, so I will never go there. Very powerful. Study the mistakes. Study the mistakes that have been made and to increase your chance of winning in investment, avoid those mistakes. In career, same. Instead of studying what makes people successful, there are many factors that makes people successful. But there are very only few factors that makes people makes people fail. Borrowing too much, spending more than what they earn, do not have work ethics, wants to get rich quickly. Yeah, so there are very, very few subset of factors that that could explain investment mistakes and failure. It's easier to zero in on mistakes than on success. So value investing is this. We invert everything. Instead of focusing on returns, focus on risk. Instead of understand what makes a company successful, understand what can kill the company. Bruce Berkowitz, one of the great value investors, said this. He has this exercise. He has this discipline that whenever he invests in companies, he tries to kill the company. I will kill this company by doing this. How do I kill this? A, B, C, D. Okay. If I cannot kill the company, or if those factors that can kill the company is the likelihood is very remote, then that's the only time I will invest. All I want to know is where I'm going to die, so I'll never go there. Now, someone asked me, how about timing the market? Okay. I'm in the markets, but you know what? I'll be humble. I've been in the markets for a decade, more than a decade. So what I'll say is this: I'm humbled by the markets. Nobody knows. Nobody knows. So value investors kind of gave up on this. So if you have, by the way, if you're good in timing the market, by all means, do it. Do it. If you have the energy, the passion, and the ability to time the market, do it. But if you don't have, then yeah, then maybe value investing is a better alternative. So instead of timing the market, know the intrinsic value. So that's why, as what I said, the stock market, also, as what Salve rightly pointed out, brokers will not like you. Brokers will not like you because you don't move the earning commissions, right? Turnover. So turnover, velocity is the name of the game. So if you're not a market timer, if you're not an active trader, if you're a passive investor, they won't like you. Markets are not designed for value investors. Remember that. Now, okay, this one I will skip for now. So start with mistakes. So here, I always tell my students this. You are not compelled to act. Mr. Market, some of you didn't type. Good. Because why? Remember this. You are not compelled to invest. You are not compelled to buy stocks. Do not, if you're not comfortable, wait for the right swing. So Tad Williams, who is, I'm not a baseball fan, so I don't know this, but I think I kind of know what he means. So according to Warren Buffett, to best describe investment, it's like how Tad Williams practiced baseball. So what did he do? What does he do? He doesn't swing indiscriminately. He waits for the fat pitch. Wait. So according to Charlie Munger, money is in the waiting. It's in the sitting on the assets. So kind of when you sit down, that's how you make money. So according to Charlie Munger, yeah. So most of the money that they made is in the waiting, not in the acting. The big money is not in the buying and the selling, but in the waiting. So what do you do? It's a very, so as what he said, was it you, Carlos, who said that the boring? Yes. Because why? Every day I wake up for what? Not because it's not, there's no adrenaline element and factor in value investing. Maybe that's why they tend to live longer than traders. No, value investors tend to live longer simply because most of the time is spent in the waiting, in the studying. So I wake up 4 a.m., 4:30 a.m. with the main assumption that I will not do anything. But when the right moment comes, when the odds are with me and not against me, especially in down markets, like what happened a few years ago, when market is most fearful, as what John Templeton rightly pointed out, at maximum pessimism you buy, at maximum optimism you sell. Okay, so then what do you do when you're waiting? It's a boring game. In a time now when we're not used to waiting anymore, especially here in, let's say, in Singapore, you would see the rush culture. So what do? You study. Right? Rob gave a good introduction about learning. You study. That's it. But the unfortunate thing is, so it took some time. So good thing is last year, so I'm very happy with the amount of money that I invested, because I spent a lot of time studying, writing down and studying my regrets. In 2008, 2009, I didn't invest that much. So I wrote it down. By the way, it's a good advice to write down all your investment decision. Yes, Salve, that's correct. Nobody wants to be a value investor because it's not sexy. It's so boring. It's very boring. And other than the fact that it's difficult. Okay. So now here, for the students here, I regretted that I didn't start earlier. So one of my regrets is when I started my career in SGB, and there in the library, I saw this book by at that time I said, who is this buffet guy? Okay, he sounds like a food or whatever, right? So I saw this book, Roger Lowenstein. It's boring. It's a boring guy, old-fashioned guy, and I regret. So I'm telling you, for the younger ones here, I'm telling you, please, yes. Oh, hi. Yeah, good to know that a fellow SGBian is here. So here, I'm telling you, in the SGB library, I saw this Buffett book by Roger Lowenstein. And you know what? I regretted not reading that book. Okay? Because I'll show you later why. So here, Warren Buffett was asked in one of his talks in Colombia. Oh, hey, John. Hey, nice. So here, what could I know to prepare for an investing career? So as what Salve said, boring. Read 500 pages like this every day. That's how knowledge works. It builds up like compound interest. All you can do. All of you can do it, but I guarantee you, not many of you would do it. So now I'm averaging 100 pages a day. So I enrolled in speed reading course, which doesn't work. I don't recommend that, but I have my own unique way. I can share that with you if you want. So, and I can retain information quite quickly because of this. So yeah, I enrolled in, this Evelyn Wood speeding read courses, because I know that the game is to absorb as much as you can and connect from different disciplines. So he reads 500 pages. My target is 100 pages a day because I'm working. My excuse is I'm working. Now, you see, this guy is inspiring. Todd Combs. So he's one of the two, along with Ted Weishler, was selected by Warren Buffett to succeed him on the investing side. He was one of the students who listened to Warren Buffett. By the way, it's already 5:26. I think I will extend. So sorry again, because I want to deliver as much value as I can. Yeah. Oh no! Don't follow the diet, Carlos. I cannot follow it. Obviously, I cannot follow it. I would die. The diet, especially. Only the reading side. So sorry. By the way, I'm preempting. No. I might extend for those of you who want to leave or who wants to leave. Please feel free to do so. Yeah, I think it's genetic. Even Charlie Munger also eats his candies. So I just want to apologize in advance. I respect your time very much, but I just want to add as much value as I can, because for many of you, maybe this is the only time I will be in contact with you. So I'd like to give you with some actionable things that you can act on. So pardon me for extending. I normally observe time except for topics that I'm very passionate about. Okay, so Ted comes. He's a student. So he said, I will defeat this Warren Buffett guy. I will read as much as 600 to 1,000 pages a day. And you know what happened? Okay, so here, he was an auditor he was a bank supervisor, BSP, was this the bank examination. Then he moved to an insurance company. So his life is inspiring because he didn't start out like Warren Buffett, who's an investing genius at a young age. So he took his MBA, then followed this Warren Buffett advice, read 600 to 1,000 pages a day. You know what's inspiring about his story? He was so smart and so good that, again, Warren Buffett took him as one of his fund managers. And then number two, Jamie Dimon selected him as one of his youngest board of director. A young man with not much experience, not much pedigree, not like Rick Fusconi, to be one of the members of the board of directors of JP Morgan, but he resigned recently. Okay, so value investing, as what Rob rightly pointed out when we started, is about this. It's about learning. It's about step-by-step learning. Every day, learn something new. It's a very, very boring exercise. Now that this is a blessing or a curse for some of you, but now that that many of you would have some time, I think you have to think seriously about how you allocate that non-replenishable source time. So think about how do you Charlie Munger said, every day become a learning machine. Be smarter every day. Be wiser every day. Learn something new. That's it. That is the value investing challenge, to learn as much as you can every day. Start small and learn as much as you can. And I'll show you how to do it. Okay, so this one I'll skip this one. So now let's go to the next part of the presentation. This will be shorter than the first part because I want you to have this concrete understanding, the elements of value investing. Why should you study value investing? Now, before I discuss that, I want to ask you, what do you think is the most important equation in investing? As what I said, I came from a quantitative background, quantitative risk management. So I studied a lot of equations. I have an accounting and economics background. So now I ask you this, what do you think is the most important equation in investing? So is it the normal distribution, DCF, okay, the bell curve, Fibonacci, what else? Black-Scholes, is that the most important equation? So here, Charlie Munger said, understanding, and I tell you, this is almost spiritual for me. So I know, sorry to sound religious, but yeah, this is almost like a religion to me now. To me, the most powerful equation is something that we take for granted, something that is easy during our college years or high school years. The equation of compounding. There's a lot. As I grow older, as you know, I have two kids. I have a daughter who's, I think, listening to me now. That's why I'm pressured. 6 years old and a 3-year-old son. As I grow older, because I just turned 35 last year, I kind of realize that there is the equation of compounding is more profound than what we think. So Charlie Munger said that understanding both the power of compound interest and, most importantly, listen to this, why value investing is important, and the difficulty of getting it is the heart and soul of understanding a lot of things. Understanding the power of compound interest and the difficulty of getting it is the heart and soul of understanding a lot of things. Our mind, if you study behavioral finance, Kahneman, the Taylor stuff, they call our brain is not designed to think about compounding. The hyperbolic discounting, something like that. We are not built to understand compounding, which is why we will not likely act on information that will help us, like value investing. Yes. So I have this book, and I have recently found this book secondhand. One of my favorite books, which I accidentally found in my high school library, Mathemagic. So there was this story about this king in India. Okay, so I was exposed to this very powerful story. So it's a story between a multimillionaire and a girl kid, and he asked the girl kid to count number of coins, and then the girl kid told her, "Oh, the original story is this, what I'm about to tell you." So by the way, for those of you who know this story, pardon me, because I really feel that this is very important and transformative. One day, there was this king, who is a big fan of the game of chess. Okay, and he had the habit of challenging visitors in his kingdom to a chess fight. Let's fight. Okay. One day, a very wise sage was challenged by this king. So the king was so confident in his chess playing skills that he said, "Hey, so wise sage, name any reward you want and I will give it to you." Okay? The sage said, "Oh, my king, I want nothing else except a few grains. One single grain on the first chess square, and then double it as we reach the end." Okay, so this is the game, huh? So just for the non-chess players, but I think most of you will be because of Queen's Gambit. What the old sage is asking for is not ambitious. It's ridiculously stupid, from a king's perspective. From the king's perspective, why? Just one piece of grain, one butil, isang butil, one grain. No, one grain on each square, and then you double, and on each subsequent squares, you double it. Okay? So the king said, "Wow, what an ambitious loser. He could have asked for half of my kingdom, and I would give him that. So fine, this is an easy one." So just to give you a context, okay. 1 cup of rice is equal to, I researched this, is equal to around 8,500 grains. Of a piece of grain or whatever you call this. 1 kilo of rice is approximately 55,000 grains, and 1 sack of rice is equal to 3 million grains. So here, if I ask you, how many grains, how many sacks of rice you think? So think about it. Don't type yet. Think about it. How many sacks of rice, or maybe cups of rice, will the old man get? Okay, think about it. Okay, so here. So let's play this game. So 1 on each square, 2, 4, 8, we double. Oh, wow, nothing. So not even For the next, so this is very important. It took 14 days, 2 weeks, 2 weeks for this old wise sage to get 1 cup of rice. 2 weeks to get 1 cup of rice. Wow. 2 weeks. And then what? It took 23 days for this old sage to get 1 sack of rice. Okay? Halfway through the chessboard, okay? Halfway through the chessboard, the wise man will get 720 sacks of rice. So still okay. So the king said, wow, just 720 sacks of rice, that's fine. Okay? To put that into context, here in Singapore, I think 1 sack of rice, if not mistaken, is 200 Sing. So around 8,000, maybe $8,000 or $10,000 there. So the wise man will get around $200,000 or $150,000 or 6 million pesos equivalent. So some good money, good amount of money, but not substantial, not half of the king's kingdom. But let's say, okay, so that's already halfway. But let's say the old man persevered. Okay, did not give up. What will happen? So what do you think? How many sacks of rice will the old man get? So now you can type. What do you think? How many sacks of rice? 1 million, whatever, 500,000, 200, 300. How many? How many sacks of rice? How much? So halfway is 720 sacks of rice. Now just guess. How much sacks of rice will the sage get? So anyone? So any guess? So any guess is okay, because I think I just want to prove a point. No. How many sacks of rice? So what do you think? Should it be 1 million, 500,000, 300,000? What do you think? So if you can please type on the chat so I can get a sense on 5 million, 5 million, good. Okay, so almost same. So okay, so see, our brain is not built to think about compounding. Okay, so good, Kenneth, but yeah, good bet. So, but it's 12 billion sacks of rice. Now, to give you a context, so it's 12 billion sacks of rice. To give you a context, how much will this be? This will be $2.4 trillion. The value of this is $2.4 trillion. And that would be the GDP of India in 2018. That's 5 to 6 times the GDP of Philippines, Singapore, and Malaysia combined. Yes, that is the power. I think the power of 72, right? That's a power of compounding. Now, your brain and my brain, when I read this, oh, is it true? I even have to do a spreadsheet to check this. Our brain is not built to think about compounding. And now, I want you to examine this case very, very carefully. What happened here is for the next 2 weeks, maybe let's think of the chessboard in terms of years. Okay, in terms of years, 1 year per square. Imagine, in the case of the wise sage, 14 days. Was it 14 days or 10 days? Or 14 days, 2 weeks. If it's 14 years, nothing is happening, just 1 cup of rice. But then if you persevere and continue, compound your learning, compound everything, be humble. We don't understand the power of compounding. We really don't. It's already proven empirically. Hyperbolic discounting, we cannot simply fathom the power of compounding. Okay? So, now here, look, if you look at this, sorry, I forgot. No, I extended this. It's not really 12 billion. So here, it's equal to, I don't even know how to read this number, 9 whatever, Google, trillion grains. So 250 years worth of rice production. If we finish, by the way, those for the one who predicted 6 trillion, you still underestimated. Even though you were very, very aggressive in your SD, still underestimated the power of compounding. 250 years worth of rice production. Okay, that is what the old man asked for. 7 years of world GDP based on current GDP, based on the recent GDP. Okay, so this is the power of compounding. And then we look at this. So this is this one. I did this just to drive home a point. Let's say you entered into this bet. So this is what you will get, 1 grain of rice, okay, is almost $0 value on day 1. Of course, there's almost no value in 1 grain of rice. You extend and extend and extend and extend for almost 14 days. Nothing is happening. On the 14th day, you get points on the or 10th day. Sorry. So let's say maybe let's think of this in years. Sorry, not days. On your 10th year, you only get $0.04. What's that? 12 pesos. Okay. Sorry. Sorry. 15 pesos or whatever. Okay, 15 pesos. That's what you're getting. Nothing. And you spent 10 years of your life to get what? 15 pesos, $0.04. Now let's proceed. On the 20th year, $40. Okay, not even the cost of one book. You overspent. You extend and extend the 30th anniversary. Oh, now it becomes a little bit more meaningful, but really not much. Okay, just $40,000. 1 million, 1.5 million pesos. Not really that big. Continue and continue and continue until you get here when you make your first $1 million, not even halfway through the chessboard. Okay? Or sorry, almost halfway through the chessboard. That's when you will get $1 million. 32 years. More than 30 years. So, okay, more than 30 years. So that's 31, 32, 35 years for you to get to $1 million. So some of you will not persevere. But then if you continue and continue and continue, okay, look, to be a Donald Trump, okay, but there's dispute on what his actual net worth is. To be $2.6 billion, it will take almost at the end of the finish line. Okay? Continue and continue and continue, you get to Lushotan level. And this is because I had a Vietnamese student base at that time. So this is the richest man in Vietnam. $6 billion. Then Robert Koch, $10 billion. Continue and continue and continue. You get to Jack Ma, although now this is significant. About it recovered. So so $40 billion. And then continue, you get to Warren Buffett level, almost at the end of the chess game. Then Jeff Bezos. And then continue the chess game. You get to the United States level. And then continue, you get to the entire Earth level. So that is, I'm not saying that you will make this. The likelihood, of course, is almost zero, or zero, or maybe even zero, but never say never. So the likelihood that you will get this is almost zero. But my point is, our mind is not built to understand compounding, the 1 grain of rice. So translate 1 grain of rice to 1 minute, 1 hour that you spend studying every day, 1 hour that you spend, developing yourself, investing in yourself. Imagine what you can accomplish. Okay. And for those of you who are students here, the younger ones, there's a lot of things you can accomplish. And I envy you. I envy your youth. So yeah. So someone said, Carlos, actually it's the 8th wonder of the world. Einstein said compound interest is the 8th wonder of the world. So here I want to warn you. Remember this, the positive side we discussed. He who understands it earns it. He who doesn't understand it pays it. You do not want to compound something that is negative. So if you have negative habits, if you're losing money, if you're borrowing money, remove that. Make sure because compounding is powerful. It's powerful on the positive side. It's powerful also on the negative side, which is why one of my favorite books, easy book to read, right? Favorite blogger also is James Clear, Atomic Habits. So his argument is simple. Start with atomic habits, with simple habits. Start with something small. In the end, that is what will matter. The small things that you do. Not the big things that you're planning, not the big things you're dreaming about, but the small things that you're actually doing. The atomic habits. Okay? So I have a number in my mind. So for those of you who are asking, what should you aim as a number? So I'll answer that later because I copied from Charlie Munger. So here, putting it together, compound interest, as I said, is very spiritual to me. Okay? But it's simple. Even a high schooler can understand this. The future value of anything is equal to the present value times 1 plus R raised to time. P is the present value, what you put now. R is the return. T is the time. Okay, so listen. Okay, I'll skip this. Okay, so here. So here, the most important factor, and as I said, that's why I envy the students who are here, is the T time, the T. Okay? Oh, they're all important, they're all important. But if I have to choose, P and T are the only two things that I can control. For some of you, maybe P is not in your control because you have more urgent things, no? You have more urgent expenditures, you have to survive. But for some, or you're not yet earning, so therefore your P should be your learning. But to me, starting now, T is within my control. Okay? So T, look, if I increase my T from 30 to 60 years, look at how so if let's say I invest, instead of 30 years, I invest for 60 years. My investment life is 60 years. What will happen to my investment? Will it double, triple? No, it will be 30 times. Okay? Almost 30 times, sorry. The importance of long runway. T teaches us this. If there's one thing that Warren Buffett teaches us, it's the importance of long runway. The reason why I'm teaching my daughter this as early as now, in fact, she's listening now, is because, you know what? That's my regret. If I started early, I don't have to be smart. I don't have to be smart. I just have to be moderately smart. I don't have to be clever. Just to have a long runway is enough. Okay? 30 times. The mind is not. Okay, now, here's a problem. Here's a problem. Return is also important. But look at how powerful negative compounding is. From a 100,000 investment over 30 years, 10%, practically you're wiping out your entire capital. So remember that. Be careful of the bad habits that you have, the bad things that you're doing, the bad habits. Why? If compounding can work for you, negative compounding can work against you big time. Okay? Now, this is within my control. So a lot of you, so especially students, I always tell them, okay, so here, spend the next 10 years working like a slave. Working like a slave. Don't adjust your lifestyle. So I never bought my own. I don't have a personal phone. So like this is a company phone. I don't have a personal phone. I never paid money for a mobile phone. It's always company phone. So that's why it's hard to contact me except via Facebook. So I have no permanent number. It's all company phone. I like secondhand. I have despite increasing my income and my net worth substantially over the last few years or decade, I didn't change my lifestyle. Moving here in Singapore, you would be surprised. My cost of living is almost similar to my cost of living in Philippines. Okay? Because we did not change except for education, right? Because I really spend a lot on my personal education and my wife and my kids' education. Because I still learn. This is something that I realize is what is within our control. Okay, return is not within your control. Don't have that illusion of control that you can control return. No matter how smart. This is not an industry where the smarter you, not an enterprise. The smarter you are, the better you perform. No, unfortunately not. Sometimes people get lucky. Okay, so what is within our control is the initial investment. Whatever we put. So my advice is for the next 10 years, spend your time studying, spend your time saving as much as you can because compounding is really powerful. Reflect on this. Save as much as you can. So that's what I did. Okay, my shirt here, I never, so even when I moved here, I almost never buy a new shirt unless my wife forced me to buy. So I always know I'm a very frugal person. I did not change. I'm just, so my only luxury would be buying signed books, first edition books. So that one, I tend to splurge. But the rest I don't. So that's my only vice, if you call it a vice. No? I collect books. So I did not change my lifestyle. Why? So here. Now I will answer the question. How much should you aim for? People talk about financial independence a lot, but I'm not, I have a very simple, I just copied from Charlie Munger. So here's what he said. So first, to be in a survival mode, you have to have 1 year worth of your expenses. Cost of living, 1 year worth of your cost of living. That's survival. To be in a thriving mode, okay, you have to have okay, and then maybe moderately financially independent, or maybe financially independent. You have to have 10 years worth of your annual cost of living. So that one, I really rushed to get into that level. But to be truly financially free, you to be on a legacy mode, you have to have 100 years of your annual living expense. Now here, listen to me. It's not about having the having that number. Is it billions of dollars? No. There are two equations, there are two factors there, the numerator and the denominator. The numerator is what you keep, not what you earn, but what you keep. The denominator is what? Your cost of living, your annual expense. If you can lower the denominator without moving like what Ann Schreiber did, you will be okay. Okay? So to be my philosophy in life is our goal in, my philosophy in life is simple. It might not be theologically correct, but my life goal is to be free. To be free in every way. And to be free, you need money, unfortunately. So you don't have to trade time for money. I see that a lot of people, because I study, okay, one of my life tips, so I always do this, I go to the older people who retire, and I ask them, what are their regrets? What are their regrets? And I learned a lot. One of their regrets is not starting early, that's one. And trying to please as many people as they can, trying to please people they don't like and who don't like them. That's one of the things that's very absurd, right? I mean, to us, it sounds absurd. Why would you please people you don't like, and who don't like you back? Unfortunately, that's what we're doing when we play this status game. So one of my favorite thinkers, also one of the gurus of the Silicon Valley venture capitalists, an angel investor, Naval Ravikant, said that. No, think for yourself. Are you playing? Are you playing? I forgot the term. It's a status game or another game. It's a more of a long-term kind of game. Okay, so by the way, I'll share you that book. That's a very good book. A New Year reading, a very good New Year reading. It's an easy read. So do not play status games. So especially for the younger ones here, status games can only kill you. Compounding can work against you. So again, I want to emphasize this. He who understands it earns it. He who does not pays it. Reflect on this equation, simple equation of compounding. So okay, so Salve, this is the book, Snowball, our favorite book. So according to the title of the book is Snowball. Why is it Snowball? Because because again, life. I just accepted this from one of the Warren Buffett quotes, my favorite quote. Life is like a snowball. The important thing is finding wet snow and a really long hill. So the R and the T. Fish where the fish swims, that's the wet snow. So that's why you have to form your own investment philosophy and explore. Where can you find the fish? Where can you fish? Okay? And a really, really long runway. It's about maximizing. Value investing is about protecting PRT. It's easy to lose. It's easy to get negative R. It's easy to lose P. It's easy to forget T. Value investing is about this, protecting P, R, and T. The P habit is the law of discipline. You have to, value investing is a disciplined approach to investing. According to Charlie Munger, his advice is this: save, spend less than you make, always be saving something. Benjamin Franklin way. Over time, it will begin to amount something. The habit of saving is itself an education. This one I agree. So Jim Rohn, a famous motivational speaker, the mentor of Anthony Robbins, he said this: don't wait to become rich. Don't desire for riches. Riches will only come to you when you have the qualities to be rich. Okay, you don't become rich just because suddenly you found this idea. No, you become rich. You earn the virtues to be rich. Although, okay, again, success has many explanations. But in general, self-made people, the seed is planted like decades in advance. It's about building this character of saving, because when you save, you learn a lot about yourself. How do you forego consumption? Willpower. How do you manage time? Okay, so it fosters every virtue, according to Charlie Munger, teaches self-denial and cultivates sense of order, trains forethought, strategic mindset, and broadens the mind. So for those of you who are students, don't fool yourself that you will only invest when you have your first million. It will not happen. Most probably, the first million will go to a car or to a whatever expensive vacation. I studied a lot of failure, and that's always the case. You become rich. You don't get rich. You become rich. You become the person. You become that person you want to be. And therefore, my advice is start investing, or at least start studying, investing your time now. Do not wait for the first million. Do not wait. That's a common mistake. Do not wait for the first million before you invest. Have the discipline to spend less than what you make. The habit R, what Philip Fisher, the patron saint of the habit R is Philip Fisher. He taught us to focus, to spend all our energy in coming up with that edge. Remember, the key lesson is investing is to find out if you're on the right side of the trade. What do you know that the other people don't know? Value investing is about focusing on safety and the best. And by definition, the best is the outstanding, the wonderful is hard to find. Okay, so listen. The R habit is like finding your soulmate, your destiny, or your partner. Okay, so how you find a how you look for a partner should be the same standard that you apply to. I know it's exaggerating, but I really believe this, because by definition, wonderful is rare. Okay. Okay, so focus, the law of focus. So Warren Buffett and Bill Gates, in one of the gathering, they were asked, what is the one quality force that you could attribute to success? And they said this: focus. So the 525 rule. What is the 525 rule? So one of the pilots of Warren Buffett, because he owns NetJets, the fractional ownership on jets. So one of the pilot of Buffett asked him, "What's your secret to success?" And Buffett said, "Oh, because I like you, I will answer it." So write your goals. 25. Oh, now it's a good time. Right? It's New Year, and 3 weeks ago we have an excuse, Chinese New Year. Write your goals, your top 25 goals. Okay, so he wrote his top 25 goals, and then what he said is this: erase goal number 6, erase up to goal number 25, and then erase goal number 2 up to goal number 4. Focus on goal number 1. And don't go to goal number 2 unless you finish goal 1. So this is the habit of focus, the R habit. This is one of my favorite books in investing. It has been out of print for a very, very long time. And I will share this with you. And this really changed I know that, books like Peter Lynch, Beating the Street is popular. Oh my, I love this book. You have to read this book. Okay, this is a hard to find book, but I think they're selling this in Book Depository. So one, I think, is an illegal copy because this was printed by another publisher, an author, I think, doesn't own the IP. But this is a good book written by Thomas Phelps. So by the way, I got this book recommendation from a great value investor, Monish Pabrai. So I asked him, so he recommended this to me. So what did he say is this? Okay. By the way, I'm not advocating for animal hunting, but I think at that time it was acceptable. So this is the analogy that he made. So he said this: focus on 100-to-1 opportunities. That's why the title is 100-to-1 in the stock market. So listen, when looking for the biggest game, be not tempted to shoot anything small. Elephants' ears are very keen. Never after firing a single shot at a guinea hen, a colobus monkey, or an antelope did I see elephant that day. So he said, when you invest, focus on the big game. So, I'm changing my philosophy on investing. So I realized, because I had some good investments. Of course, in this market, you can get 10x, 20x. But I'm focused on getting, that's why I developed this barbell strategy. The 10%, I'm looking for 100x. You know why? What I'm thinking is this, frequently, the sad thing is we always go to, by the way, remember this, people think, there's a misconception, and I see this not only among my students, but among my clients as well. They think that the blue chip companies are safe. Not really. Safety is on the price. If you buy it expensive, no matter how good the company is, no matter if it's Ayala, Meralco, whatever. So I want you to be very clear. Not all good companies are good investments. Okay, some great companies are. Oh yes, I agree. Yeah. Oh yeah, this is good. Yeah, this is good. Yes, I read this. This is good. Yeah, but real friends tell you when you're wrong. Yes, that's good. Yeah, and I could imagine Charlie Munger saying that because he's always, he's the negative side of Warren. Warren Buffett is naturally optimistic. So here, when looking for this opportunity, Okay, have the courage to look for 100 to 1. Why? Because why? Again, the premise is this. I'm not telling you to blindly speculate on Bitcoin or whatever. What I want you to think about is this. Okay, think about the effort that has to go through in your study, the scuttlebutting that Salve described, the scuttlebutting that you are doing. Don't waste this. Look for big things that matter. Okay. Now, of course, that would be also risky. Okay, again, so by the way, for those of you who think that blue chips are safe investments, wrong. So the Nifty, I think there's a Nifty 50 company. So it used to be the popular strategy in the US. So it's a popular CT product, the 60s, I think, or 70s, the go-go years, where they said, oh, don't study. Don't read Benjamin Graham, useless. Just look for the 50 biggest companies and that's it. Buy at whatever price will go up. Oh my, that costs a lot of people. That costs a lot of people to lose their money. Okay, not all great companies are great investments. Not all bad companies are bad investments. Okay, so I think I'll share with you this. I think this book is a good book, so I want you to read it. The argument is pretty simple. Sometimes 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 adopting a 100 to 1 approach is safer than the blindly diversifying 1 over n, 1 over 25, or 1 over 500. I remember what George Soros said. It doesn't matter how often you are right, but what matters is how big did you gain. I'm paraphrasing. This is not the exact quote. How big would you gain? How big did you bet? And how big did you gain when you are right? It doesn't matter how oftentimes you're wrong. You may be wrong 90% of the time. That's okay. This is not school where you need to grade 90%. What matters is on those times when you are right, how big is your bet? How big is your bet? Okay. So the law of focus tells us this. The reasons why so few of us profit by 100 to 1 stocks are: first, by the way, I studied 100 to 1. There's a good study that I recommend in the Indian stock market. So read about the qualities of wealth creators. So I'll reveal it to you now because I may not see you. In a nutshell, great visionary management. So that's it. So, but to get to that conclusion, you have to understand the business, because for every visionary management, there will be Al Dunlap, there will be Kenneth Lay, there will be this creative financial manager who will cause you harm. Okay, so why few of us profit by 100 to 1 are: first, we try not to do so, and second, that we are not even wise or lucky enough. So when we are wise and lucky enough to buy one, we don't have the courage to hold on. We don't have the vision to see a 100 to 1 opportunity, and we don't have the courage to hold on. So again, another experiment to prove to you. So 3 people, okay, person 1 invested $1 from 9. So this is actually from Morgan Housel. So I think Carlos, he copied this from Jason Zweig's article. Okay, so one of his compounding articles. So I'm also a fan of Jason Zweig. Another great journalist who I think is a good investor. So this girl invested $1 per month. Doesn't know economics. Do not know what recession means. Person 2 is an economics major. So the strategy of person 1 is to invest $1 per month. Simple. You might even say stupid. Okay, stupid strategy. Person 2, invest $1 when the economy is not in recession. Wow. And then when the economy is in recession, because I'm smart, I'm an economics major, I studied macroeconomics, I know this. I know all of this. I'm good in market timing. I will sell if it's in recession and put it in cash if it's in recession, and then buy only when the economy is not in recession. So that's his strategy. Invest again when the recession ends and continue this pattern from 19100 to 2019. He is smart and he thinks he knows about economic cycle. Person 3 is a hedge fund manager. So it's already past 6. For those of you who want to go, feel free to do so. Sorry again to extend. Really sorry, because I really want to add as much value as I can and deliver this to you. So next, person 3, very smart. a hedge fund manager, invest $1 when there's no recession, but knowing that it takes some time before it recovers. So knowing that markets tend to react, and he knows that recession tends to have lagging effect on the market. So he wants to time the market more precisely. I will sell only 6 months after recession begins. I will not overreact. And then I will buy only 6 months after recession ends and will not act prematurely. Okay, can I ask you, for those who are still here, who do you think will make the most money? Person 1, person 2, or person 3? Can you rank them? Person 1, okay, so good. 1, good. Yeah, now you know, good, because your brain is not built for compounding. So, and oh my, by significant multiple. Person 1 who naively invested $1 every month, okay, for a very, very long time. But of course, there's a period, no, structural bear period. Person 1 from 1900 to the period to 2019. Person 1 with no economics knowledge and seemingly stupid strategy earned 435,000. Person 2 to 57, and person 3 to 35,000. Okay, so here. Sorry, wait, let me just fix this. Okay. So here, so remember this, courage to hold on, the discipline, that's very important because we don't understand compounding. So do not give up, always be persistent. So according to Thomas Phelps, sorry. Oh, no, wait. According to Thomas Phelps, the person seeking to multiply his capital by 100, actually, counterintuitive, right? Because in traditional economic finance, CAPM model, Markowitz tells us the higher the risk, the higher the expected return. Although some people think higher risk, higher return, that's wrong. That's higher risk, higher expected return, not actual return. Right? By seeking to multiply his capital by 100x, runs the less risk than the individual trying to make 5 points or even double the money. Why? You don't have to be right all the time. Okay? You don't have. That's why I'm adopting what Nassim Taleb said, the 90-10 rule, no? The anti-fragile portfolio, the barbell portfolio. So where you don't focus, you avoid the middle, you focus on the extremes. Be extremely conservative. It's like Jekyll and Hyde. You be conservative, be extremely conservative on the 90%, or now I'm getting to 80%, 90%, and be extremely aggressive on the 10%. Okay. So, by the way, if you have time, right after this, can I ask you to watch the movie Becoming Buffett? It's available in YouTube. It's an HBO movie. I'll send you the link. It's a very, very good. It's a good way to start, especially for the visual learners. So when he was asked, what is his secret to success? Okay, this is the third habit of value investing, the law of lasting, the law of compounding, the law of lasting power, the law of permanent value. So he said this. In a group of students, he said, let's say when I turned 16, a genie had appeared to me, and the genie said, Warren, I'm giving you a car of your choice. It will be there tomorrow morning. Brand new, it's all yours. There's one catch. This is the last car you're ever going to get in your life. So it's going to last a lifetime. When you think about people you associate with, your friends, when you think about your investments, when you think about things that you do, think about this. Let's say that you only have this one car, one chance. Will you act? How will you behave? How will you act differently? So I will. I will tell you a story of two people. Okay. So basically, then he said this. No, imagine you have an index card. You can only punch 20 holes. So those are the 20 decisions you can make. When I talk to great investor, whether it's for example, I'll give you an example. You know Benjamin Graham, we discussed, right? He's a good cigar butt investor, and he's invested in a lot of this this cheap companies. You know what? When he died, he revealed in his last interview, he made most of his money in just one stock, in Geico. At that time, it's a growth company, not even a value company. If you look at the Berkshire portfolio, there was this meeting. I forgot when, was it 2004 Berkshire meeting? Charlie Munger revealed that they invested in 500 stocks, but only a few succeeded. Warren Buffett is not a successful investor because he is right all the time. He made so many mistakes. But when he make mistakes, these are small mistakes. But when he's right, he bet big. Again, I think Pat mentioned Kelly criterion. I mean, so that's also one of the, I think, one of a good mental model that you should apply. How especially in terms of thinking about how much to bet. So remember this. Remember this. It's about focusing and deciding. What if you can only make 20 insights in life? And by the way, I'll tell you this. If you look at the history, I read a lot of biographies and history of great people. These great people, for example, Henry Ford, if you watch that very good documentary, The Men Who Built America, National History Channel, he was, people mock him for being stupid because he doesn't know the name of this general or whatever. He doesn't know many things, but he knows a few things. He knows how to build a car. Okay, remember this. You can only have 10 to 20 great, maybe that's too much, great insights in your life. Okay, so if that is the conclusion, if you accept that, then what will you do? You will focus your energy on the few things that matters, on things that have lasting and permanent value. I will tell you a story of two different billionaires, two people. This guy, James Simons, Matt Genius, Renaissance Technologies. He opened up. I was offered, so I kind of regretted. So he offered this to smaller time investors, his funds, but he closed his funds because why? He has a hedge fund named Renaissance Technologies, and there he will not hire CFAs, he will not hire MBAs, he hires astrophysicists, quants. So there's a good book that's written about his style, The Man Who Sold the Market. And you know what? He's a great, yes, the richest mathematician. And in fact, he's a legitimate mathematician. He won I forgot the name, the Nobel Prize for Mathematics. He won that prize. He's a legitimate genius, mathematical genius. Renaissance Technologies. Okay. He performed 66% per annum. Now, Warren Buffett, on the other hand, looks pale in comparison. He performed only 20% per annum. Now, who is a better investor? It's very clear, right? Who is the smarter investor? It's very clear. Much as I hate to admit this, Jamie Simons is the smarter investor. But I'll reveal something which will shock you. Jamie Simons is poorer than Warren Buffett. And remember, Renaissance is not a publicly listed company, or at least it's close to investors for a very long time. So he gets most of, and his employees gets most of the return. $24 billion against $86 billion. Why is Warren Buffett, richer? Why is he the greatest investor? So when we say Warren Buffett is the greatest investor, it's not because of his performance. It's not because of the R. Because of why? Because Buffett started early. So I have 2 kids, and this is a gift that I want to give them. So by the way, we are jointly writing a book, Value Investing for Kids. I'll share it with you for free if you're interested. So Buffett has accumulated $84 billion. Look at this. This is very surprising, this statistic. Warren Buffett has accumulated $84 billion of his net worth after age 50. So look, 86 billion, although it fluctuates because of the Berkshire prices, 84 out of 86 he accumulated after age 50, like the chess experiment. But where is his edge? His edge is in the T. Warren Buffett has been investing since age 10 to 11. He started reading at age 7 from his father's book. He read all the books on investing in the Omaha Public Library, and he started to invest, I think, city services at age 10 to 11. Jamie Simons started investing at age 50. He is great. Yes, Medallion Fund was up 76%. I think Pat, I think this is 66% per annum, if I'm not mistaken. But yeah, good to know, 76%. But look, the reason why Jamie Simons is richer than Warren Buffett, okay, I think none of us can replicate Jim Simons. The R. None of us can replicate even Buffett's R, 20%. Okay. But the reason why Warren Buffett is great is not because he's good in investing. No, he's not good in stock selection. In fact, as what I told you, out of the 500 stocks they invested, only a few made money. Okay? The reason why is because he has been investing. He's been betting big, that's true. But he's also has been investing for 80 years. So at the age that Simons is investing, Buffett has already been investing for 40 years. So Jason Zweig conducted this thought experiment. What if instead of investing at age 11, Buffett started investing at age 30 with a starting net worth of 1 million pesos. Okay? He continues to earn 22% per annum and he retired at age 60. He stopped at 60. Okay? What would be his net worth at age 60? Okay, can you guess? He is $86 billion now. What do you think will be his net worth? Can you type in the chat? What do you think? He started at age 60, at age 30. Okay. But then he stopped at age 60, but he continues to earn 22% per annum. How much do you think will be his net worth at age 60? Can you guess? If you can type in the chat so I can, so how much do you think will he, don't use spreadsheet for those of you who are mathematically inclined. How much do you think will be his net worth at age 60? Is it, I don't know. No, can we make dollars? Because it is in dollars. So, okay. No, it's okay. It's okay. So $50 billion, half, okay, fair assumption. $10 billion, okay, fair assumption, $10 billion. Yeah, because he did not last that long. Around $8 billion, $9.7 billion, okay, $1 million, good. James, you've read Jason's, okay, close to James' estimate. Wow, it is so different. Warren Buffett is not rich. Even if he performs 22% per annum, he is not rich. $12 million. Okay, $12 million if he stop at age 60. So what's the lesson here? T is something for some of us still within our control, and for many of us, something we cannot do anything about. For the younger ones here, my message here is simple. Start now. Start now. Compounding, you cannot understand the power of compounding. Start small and start now because you don't understand this. I don't understand this. I continue to remind myself about the majesty and power of compounding. And it is, I've read so many, I've studied so many equations. I've been CFA, accounting, economics, and also derivatives professional. I learned so many equations, but nothing is more applicable to day-to-day life and more consequential than this simple equation of compounding. So start now. Okay? Because why? Your brain is not designed to think about compounding. And Warren Buffett is different. When he thinks about, he thinks in present value terms. His mind, if you ask me, Salve, in the book, The Snowball, I think there's this very, very interesting anecdote there, how good Warren Buffett is in terms of understanding discounting. Okay? Never depend on single income, make investment a single source. So these are tips from Warren Buffett for the baby investors. Okay? Save as much as you can. Do not play status games. Play long-term games. Okay? And never depend on a single income. This is very important. This is very important. In this age of disruption, do not trust your employer. Do not really trust your employer, not because they are bad, but because they also don't know. I'm in an industry, in a sunset industry, in the banking. So I can feel it. Okay, I can feel that the discussions now are Tony is also in banking. So we're in a sunset industry. There's very little growth story other than defense of existing business. Digitalization is the name of the game. So I know that at some point I will lose my job. That's why I am rushing. That's why I am quite happy with the decisions I made 10 years ago. So things are getting disruptive, and therefore my advice is never depend on a single income. Make investment. Whether you start your own business or you invest, but triangulate, always triangulate. Okay, so how do you cure this hyperbolic discounting? Because this is what will stop you from acting. No matter what your knowledge is now, whether you learn a lot from this session or not, what will stop you is not book knowledge, like what Rick Fosconi, but your ability to deal with this, your mental defect, which is your inability to understand compounding. So what do you need to have? A future plan? Write it down. Now is the best time to do it. Write it down and execute. Write your investment philosophy. Write your investment goal. Write your standards, 10 years, 100 years of expenses. Write it down. Okay. Believe that the future is not, adopt a non-predictive view of the world. Okay. Remember that. Forgive yourself if you made wrong decisions in the past in terms of expenditures. Forgive yourself. Move on. Write it down. T is too the stakes are so high that if you procrastinate, if you lose that if you lose that willpower to continue, you will regret. And here's the most important thing. I do this, and sometimes it appears, I adopted this Bill Gates Think Week. So before New Year, I will rent a cheap hotel. So now I cannot do that because of COVID. But I did that in a coffee shop. So talk to your future self. And then imagine and visualize. That's how you cure compounding. And you know what? Bill Gates said, we always overestimate what we can accomplish in 1 year. We underestimate what we can accomplish in 10 years. Because I write everything, I keep a daily journal, a daily, detailed journal. So if you're more of a techie guy, Penzu is a good website if you want to do that. But I'm still old school. I do combination Evernote and Penzu, but then I print it and then compile it. I have a notebook, so I write as much as I can, because you know what? Your mind will trick you. Your mind will trick you, and your mind is not built for compounding. Unless you pre-commit and pre-decide, it will not happen. Okay, so here, an example about haircut. So here, he can, at the age of 10, in this book, Snowball, his sisters, Doris Buffett, kind of think that he's a weird man, because he always think about $1,000, not in terms of $1,000 as we see it, but in terms of its future value. Okay, so he knows that $1,000 be 1/6 after 10 years, and in 50 years it'll be $120,000. We're just not built to think exponentially. Okay, so in fact, in Omaha there's a joke. When he said he just got his haircut and he paid $31,500. So one of his neighbors, he called this as the Buffett's folly, because he plays in his mind the $31,000. Sorry, this one $31,000, not his haircut, but the money he spent to buy his first house. The $30,000 practically nothing, given his net worth at that time. He intuitively knows that this will be, he sees it as $1 million. By the way, it's different, knowing and feeling it. Feeling it as $1 million is different, which is why for some people, you see $30,000 as $30, meaning spend it. Because to you, it's just $30. If you see $30,000 as $1 million, you will do everything to preserve it. So that's why he will mutter things. This is the Buffett's folly, haircut. Would I spend $300,000 for a haircut? For him, a few dollars that he spends, when compounded, will be $100,000 in the future. Okay, so amazing how he thinks about this. But then again, we are normal human beings. We are not. So as Patrick said, they're better investors than Warren Buffett, Jamie Simons, better compounders, maybe Julia Robertson. But yes, his future value, his masterpiece, the Berkshire Hathaway, is unfolding in our eyes. And there are still a lot of skeptics. Again, I'm not saying that Warren Buffett is a great investor. I'm saying he's the very best and disciplined investor. He is great now, because when you say great investor, are you talking about P, R, or T? Warren Buffett is a P and T grade, not an R grade. I can admit that. He's not a George Soros grade, but he's a P and T grade. P because he has the discipline to preserve whatever he can, and T because he started early and he never stopped. Okay, it's unfolding as what Salve said, before our eyes. So, in a nutshell, the fourth, if you bring this together, how do you accelerate? So here, In a compounding equation, there's a way to accelerate. How? Instead of thinking about present value, convert it into PMT. What does that mean? Make it more regular. Deceive time. Instead of investing in monthly, on a monthly basis, think about investing in yourself on a daily basis. Instead of investing on a daily basis, think about investing on an hourly basis. Okay, that is how you trick time. How we make time. We create time by doing PMT, frequency. Make it more atomic and make it more frequent. And then the over N, compounding frequency. Now, there are other smart ways. How do you do that? Inversion. Okay? Think about other people's mistakes. Learn from other people's mistakes. There's a reason why I like to read biographies. Because why I would, okay, it's I think they say that experience is a best teacher, mistake is a great teacher, but to me an even greater teacher would be what? Other people's mistakes. Let other people. So Charlie Munger said it justly, joke one time. He said that that why should I make mistakes when I can watch other people make mistakes? So study other people's mistakes. What makes them? Read biographies, read history. Okay? Read history. There's a good book by Ray Dalio about the changing world order. I'll share that with you. So read market history. So a lot of people have this assumption, we are in a new world, new valuation logic. 40% per year is correct. So I have this Daniel Kahneman, Thinking Fast and Slow, said it very nicely. A lot of people go into investing without actually thinking about the base rate. What's the base rate? You want 50% return, 70% return? You think you can make it? Now, again, the future is not predictable. So before you even attempt to answer that question, you have to answer this question. What is the likely scenario? What is the base rate? How much is the likely? 10%. Then you adjust your belief based on that. So read market history makes you smarter, in terms of understanding what are the base rates. So I know that CFA says teaches WACC, weighted average cost of capital. Investment banking, we use WACC. Financial markets, we use WACC. So cost of equity, weighted cost of equity plus the weighted debt times 1 minus T over the cost of debt. Okay, that's established now. But here, my advice to you is have your own discount rate. The cost of equity from an issuer perspective, don't blindly follow models. So I have a simple discount rate, 10%. Okay. Now, is that right? No. So it's my way of saying I have to say no to many things. If I cannot make at least 10%, I will say no to the investment opportunity. Same thing. If the future returns, how do I sell? If the future returns, it will not be more than 10% per year on an optimistic scenario, I would definitely sell. Okay? Number 3, we know, if you've read the book Sapiens by Yuval Noah, I don't know if I pronounce it correctly. So he said this, we read history as if human beings are the only people we can learn from. So yeah, I'm guilty of that. I read Will Durant, I read the classic history. I love it. I love the history of civilization. But there are many other things that you can learn from animals, creatures, biology, and by the way, So one of the favorite books of Charlie Munger, if you want to understand him, is this book by Richard Dawkins, The Selfish Gene. So it's a biology book. You can learn more about how organisms work and extrapolate your understanding of how organisms work into how companies scale. So what he's saying is adopt a multidisciplinary approach. Widen your reading interests. Don't confine your reading on economics and finance. We know so little about the markets. This is a very, very baby industry. We can learn so much from physics. Charlie Munger, by the way, is a lawyer and a physics major. We can learn so much from biology. We have to have this repertoire of mental models. So I have a good memory, not because I have a good memory, but because I have this mental models, and I copied this from Napoleon Bonaparte. So he would have this series of things, of cabinets in his mind. And for physics stuff, he will do this. So from time to time, I will use and tap on this mental. And by the way, that's the advice of Charlie Munger. Have a lattice work of mental models. So I think some of you mentioned bell curve. Yes, probability is one. Science is one. Mathematics is one. Psychology is a very important. So be multidisciplinary in your approach. And then start small. Atomic Habits. So in a nutshell, these are the things that I recommend you to pursue. And this, I'm still evolving. So I'm reflecting a lot on the spiritual meaning of compounding. P is the value of discipline. You just have to have the discipline, the courage to start. Okay, the courage to start. Savings. You have to have something to compound. To have a large to have a snowball effect, you have to have a snow. You have to make a small snow. And start with your investment philosophy. Start now. R is about tenacity and perseverance and focus. Okay? Continuous learning, expanding. Developing your circle of competence to have an edge. Fish where, this is by the way what Charlie Munger advised me, and I really take this serious. Fish where the fish swims. Okay? Do not do not force yourself to buy Tesla, Apple, if that's not within your circle of competence. Okay? Fish where the fish swims. Find where opportunities are abundant. If you ask me, it will be Philippines, China, and to a small extent US. That's why I started to go, and also India, but not anymore. Sorry. Edge. Find an edge. What is your edge? Remember this. I started with the discussion about markets, because why? Again, market is smart. If you don't understand that, you're likely the fool in the transaction. So before you act, before you buy, understand why are you, have a good explanation, why are you on the right side of the trade? And then lastly, focus. Okay? And then T is about the patience to hold on, multidisciplinary learning, to find the staying power, the courage to look for 100x. And this is important, the capacity to suffer. Because much of value investing is about mean reversion. If Mr. Market is pessimistic, eventually, in the long run, Mr. Market is rational. It cannot be. You can be irrational for a short period of time, but not for a long period of time. Okay? So you have to have a capacity to suffer. And therefore, my advice is this: find companies who have the capacity to suffer. And now it's more important. One of my favorite authors, Scott Galloway, who wrote a book, The Four, very good marketing professor from NYU. He recently wrote a book about COVID-19 pandemic. Read that book, very insightful book. So basically what he's saying is companies who will last are the stronger companies. So the bigger will get stronger, the stronger will get stronger, and the weaker companies will disappear. Maybe that justifies the valuation, because again, there is no instance in history where the bigger companies, the biggest companies, are more dominant than the comparable dominant companies before, and they have a almost zero marginal cost business model. So my understanding on this is not final, and I'm also evolving in terms of how I understand. And what you learn from Warren Buffett is this: do not be a fundamentalist, religious about value investing. You have to evolve. If Warren Buffett stopped listening to Charlie Munger and Phil Fisher and adopted the same model that Benjamin Graham taught him, he will never be the Warren Buffett that we know now. He will be a good investor, but not a great investor. Okay? So we have to understand this. We have to evolve our understanding. Now, some of you, so I'll give a brief answer to this. Some of you may be seeing that value investing is dead. Yes, traditional value investing, Benjamin Graham, is definitely dead. The FAMA French model, the price to book value, no longer works. Why? Look at the top companies in the US. You look, who are the top companies? Apple. Who are the best performing? Google, Facebook. These are companies with low book value. Why? Because these are companies where most of their assets are intangible. Now, I've been trained in accounting, and for those of you in SGV, you will know that accounting has not kept up with the realities of the present. So there's a good book, The End of Accounting by Baruch Lev, where he said, no, the reason why value investing seemingly no longer works is because of this. Our definition of book value is obsolete because accounting, intangible assets accounting, is obsolete. Why? The only intangible asset we recognize in the book are goodwill, meaning if you overpay, if you pay above book value, that's the only intangible asset. But look at company like Apple, who almost never acquires big companies, never make big acquisitions. All goodwill brands are internally generated. They tend to be undervalued from an accounting perspective. So we have to evolve and be humble and not be moralistic about value investing. Now, why study value investing? And this is to encourage everyone. If you want to be the best surgeon in the world, you have to go to medical school. You have to study surgery for how many years? If you want to be the best teacher, the best whatever, the best lawyer, you have to go to law school. Now, if you want to be the best investor, although most of the good investors I know have CFA, you don't necessarily need a CFA. You don't necessarily need masters in finance. You don't necessarily need MBA. In fact, this is a clear example. Ann Schreiber and who's this? Rick Fuscone, who's very trained. We see that all success in investing is behavioral and not brain, because it's about T. Okay? So and we have all this story. Ronald Penny, janitor, very disciplined, live a frugal lifestyle, died $8 million. Oh, my favorite guy, Michael Burry. I think he also inspired me to pursue investing. If you watch the movie The Big Short, he's Christian Bale here. He's a medical doctor, and he recommended, by the way, if you want to start, he recommended some good books, Buffettology, the book, The Warren Buffett Way. I'll share it with you after this seminar. What is inspiring about his story? He started late. He's not Warren Buffett. He's a medical doctor. And what is inspiring about his story is he did investing on a part-time basis. Okay? On a part-time basis. Oh, yeah, Pat, I've read that article. It's a good article. Yeah. Yes, correct. And also, Patrick, to add to what you recommend, I'll send it to you. The Howard Marks letter, the recent one, value investing versus growth investing. He really said that we confuse value investing with low valuation investing. Value investing is, thank you, Pat, for citing this, because this is a great article. Value investing is different from low valuation investing. Okay? It has evolved now. It has evolved significantly. Now, but going back to my story about Michael Burry, he's a medical doctor guy. And you know what? He suffered. He has Asperger's syndrome. Asperger's syndrome. And you know, this is his edge. Because at that time when everyone else is optimistic about that, by the way, when I started specializing on CDOs, collateralized debt obligations, but on the audit side, not on the front office side. So I kind of understand how to price and value CDOs. And that was my specialty, and it exploded. So that was good, the baptism of fire for me. That's how I started my first, consulting firm, so valuing CDOs. And I got my first job in financial markets because I have to value a CDO portfolio of a local commercial bank. Now, he started taking a different view from what the experts are saying. And you know what? The good thing about him is he wrote blog posts about this. And it's a classic in value investing. He read books by Buffettology by Mary Buffett and some other good books which I will share. Peter Lynch. Okay, so he's inspiring because he did this on a part-time basis. Okay, so for those of you, so I had a student in my value investing class. So he's a full-time businessman. He owns a business, and he told me he used to be a technical momentum investor. Oh no, momentum trader. Sorry, momentum trader. But then because he didn't have the time to monitor it, he decided what will work for him, and also empirical studies that he have seen. What will work for him is to adopt a more of a business mindset. Whether you call that value investing, up to you, or it's up to you. So he did this on his night shift. So for those of you, so the reason why, when I had my two kids, I was told by some of my first kid, I was told by some of my colleagues that you will not find time to read anymore. I love reading so much. I love investing so much. I love studying so much. So what I did was, you have to make trade-offs, right? So I wake up 4 a.m. So I make sure I sleep with the kids at 10:30, 11, and I wake up at 4 a.m. Then I come to the office quite late, so before 9, 8:30. But then I will, good thing that there's no traffic here. But holidays every day. You can test me. I wake up 4:30, and all I do is boring studying. I was inspired by Michael Burry also. And a lot of things and also this guy, Monish Pabrai. So you know what happened? He's an IT guy, not an investor. And suddenly, sorry, this is wrong. This is not the Roger Lowenstein guy book. So when he was in the airport, flying from Chicago to New York, I think. So you know this airport stand, right? So they sell bestsellers, easy to read books. So he bought this book, Um, sorry, it's not here. Beating the Street by Peter Lynch. So in that book, in the intro page, that Peter Lynch guy, his famous fund manager, recommended or mentioned Warren Buffett. Then he started to explore about Warren Buffett, study about Warren Buffett. And you know what? He was so grateful because of this happenstance. Had he decided to not to watch, I don't know, Rambo instead of read this book, he would not have started on this venture to invest, learn to, like Ann Schreiber, take ownership of your investing, your own investment. Okay, I'm not saying that you don't allow you don't look for a good fund manager, but at least you take ownership about your investment philosophy and decision. And then what he did, he sold his company for $10 million and he started investing. And now he's one of not lately, but he's one of the most successful value investors. And he also wrote a good book, Dando Investor, highly recommended. Now, so this book, if you don't believe that you can do this, there's another good book I can share, a soft copy if you want, Warren Buffett Next Door. It's about the retail investors who are able to apply value investing and outperform the market. Inspiring. One of them is even Filipino, okay, or married a Filipina, American who married a Filipina. Very inspiring stories. How simple modifications or decisions and commitments could change. And this guy, my friend Gautam Bade, who wrote one of the best books on value investing in the recent years. This, to me, a spiritual book on value investing, The Joys of Compounding, available in Book Depository. So I'll share. So he's like me. He's based in Hong Kong. He's an investment banker. So we discussed. So because as what I said, I've been thinking about leaving my full-time job. So I'm leaving. I'm thinking of leaving it soon because I'm almost there. I work on this for quite a few years. And I asked him, how did you find the courage to leave a lucrative job in Deutsche as an investment banker? So he told me that, yeah, if this is your passion, if this is what you want, so save as much as you can, maintain a low cost, low overhead, and study the market. So you know what he did? He know that he moved to the US. He moved to the US and gave up a lucrative career in investment banking, fixed income, but lucrative. Took the CFA. Yeah, so he told me he took the CFA. So it's also an endorsement for CFA, and moved to the US to pursue a stock market job. But he was rejected because he has no experience. So he took a minimum job as a hotel clerk at a hotel in San Francisco. But he purposely looked for a job where he will work at the red eye hours, 11 p.m. to 7 a.m. Why? Because that's a time where it's less busy. And you know what? What he did there? He read as much as he can, studied as much as he can. And what he said is this: the 100 of hours he spent resulted in him securing a portfolio. And now he's one of the up and coming value investors. So in fact, I asked him for permission to teach his book, The Joys of Compounding. So I'm launching one I'm not sure whether in Acquire Academy or in Ateneo. So I'll let you know if you're interested. But even if you're not interested, it's okay. I'll share with you as much as I can. I have a full-time job. I'm doing this also to learn and also to give back because value investing has a long history and tradition of teaching. And so what I said, my challenge to you is this: if you get older, you see, if you get older, investing is a skill set that will be, that you only get better as you grow, as you get older. It's not like surgery. It's not like other skill set. So it's another incentive for you to study investing. Okay. So, and also, again, if you want to live long, many of the value investors tend to live longer. Okay. So Patrick, and for some of you who are more empirically oriented, forgive me for this is my anecdotal anecdote. I have no scientific basis, but I tend to see that great investors tend to live longer. Again, no empirical basis of saying this. And you know what? Another advantage of learning this is you can pass on this skill to your kids. This guy, Philip Fisher, the son Ken Fisher is a billionaire. Okay, he was accused of sexual harassment lately, so I don't necessarily endorse him. And if you look at his performance, his flagship funds, he's not really a value. He's more of a marketing guy, if you ask me. Nothing wrong with that, but he's a marketing guy and has significantly underperforming the market. But he is good in marketing. He wrote many books, which I also like. The 10 Roads to Riches. Yeah, so I think that's the only book I like. He's the son of Philip Fisher. And when he was interviewed, many of his investments were carried over from his father's investment. Walter Schloss. Irving Kahn and the son. Forgot the name. Again, so learn from him. So Howard Marks, who has a son, Andrew Marks, also like that. And Warren Buffett also, his dad was a stockbroker. His first books he read from his dad's library. Okay, so Howard Buffett. Howard Buffett. That's his father. So again, there's one more incentive for you to study. This is a skill set that that your kids can inherit. If you can teach this, you can give them intergenerational advantage. Compounding works, and that's what and one of the famous sayings that I like, that Charlie Munger said, never interrupt compounding unnecessarily. So this is a skill that we can pass to our kids. So last, what to do. So by the way, I'm almost done. So maybe 15 minutes, I'm done. Sorry again. So I'm not a good because I just want to discuss as much as I can. So this is 250 slides because I cannot choose what to say, because I want you to get as much value as you can. But again, feel free to leave if you have to. Thank you, Salve. So here, overriding objective in value investing is this: what do you know that other people don't? Are you on the right side of the trade? If you cannot understand this, please, if you cannot have a good answer on this one, do not invest, do not act. Now, if you want to outperform the market, you have to have a variant perception. To overperform means what? You cannot follow the average. You cannot follow the crowd. So according to Michael Steinhardt, one of the market wizards, if you've read Jack Schwager's book, a very good hedge fund manager, but he stopped early, he retired early. So he said this, he has this good mental model. In order for you to outperform a market, you have to have a different view. But that view should be different and right, not different and wrong. Okay, you will lose money. Okay, the variant perception is this: having a well-founded view that was meaningfully different from the consensus. Okay. When it's an intellectually advantaged, disparate view, this includes knowing more and perceiving the situation better than others. It's all about the edge. Find your edge. Okay, so understand this. Find your edge. Gossip is not an edge. Insider trading is illegal. Now, value investing, how to apply value investing? How do you organize your value investing process? So Columbia Business School has this very good framework. So you start with a search process. Fish where the fish swims. Only to look for good. So I can recommend the Manual of Ideas is a good book. Also a good website. So there are many. If you want, I can share with you some good resources. Yeah. Okay. Yeah. So, thanks, Chris. So search fish where the fish swims. Okay. Find where the opportunity is. How do you select for opportunities? There are tens of thousands of listed companies in the US. So how do you focus your energy? So there are some themes now so basically we clone. One good advice is to clone. So look for what the other good investors are doing, because presumably they've done the due diligence, and then you do your due diligence. And next, this is counterintuitive. It took some time before I accept this, because I was trained as an accountant and I was a charter holder. So we always start with a research process, but no, the Columbia way is valuation first, value first. Why? Because once you start valuing, your objective is to zero in on the factors, where your valuation is heavily reliant on. So do the valuation first before you research. Because why? Counterintuitive. When you do the research first before valuation, your mind tends to be more biased. Oh, you read all the good articles. Oh, I have this memoir, the biography of Elon Musk. Elon Musk will save the world, will bring us to Mars. Then I have a distorted view of Tesla. Then instead of viewing Tesla as a car company, maybe I will view Tesla as an Internet of Things company or an out of this world company. Okay, so that's why valuation first. Be objective. So I will tell you that the Columbia way is different. And then research. Now, value investing is not for the lazy. You have to understand Michael Porter. You have to understand business, competitive strategy. You have to understand microeconomics, game theory. These are the things that you need to understand. Research. You have to interview management. And then the last step is risk management. Okay? So first, fish where the fish swims. Second, now, when you do valuation, so some of you, Carlos, are fans of Damodaran. I'm a fan of Damodaran. He's a great teacher, but he has value investing is different. We don't apply DCF. We don't apply DCF. Because why? For those of you who've been doing DCF, discounted cash flow, you know that it relies on too many assumptions. What's that assumption? Terminal value. Terminal value. Okay. You see, people, can you forecast what will happen to you tomorrow? What will happen to a stock price tomorrow? You can, right? Because it's a Sunday. But let's say on Monday, you cannot. Tuesday, you cannot. Wednesday, you cannot. But how come, when someone shows me a valuation and with a certain face, I will immediately fail that person and look down on that person. Why? Because he don't know what he don't know. Because when you value for 10 years, 15 years, and 20 years, it is subject to what? To significant, huge valuation errors. More than 50% of your valuation in a DCF relies on your estimates of the terminal value. If you cannot predict next year, don't go to me and tell me that you can predict 25 years, 15 years. Okay? That's a lie. Okay? That's a lie. That's intellectual dishonesty. And therefore, traditional value investor, so Charlie Munger, how do I say, verified this. He confirmed that he has never seen Warren Buffett do a DCF. Okay, so the focus of value investing is not valuation, but the identification of the sources of value. Okay, because when you do DCF, it's prone to estimation errors. And you know what? So if let's say you have coffee, and I put a little poison in the coffee, terminal value estimates, a little poison in the coffee. Would you drink the coffee? Of course not. If you have a food, there's a small insect there. Will you eat the food? Of course not. It's contaminated. It's a cardinal rule in data analysis that you cannot mix bad information with good information. There are good information in evaluation. For example, your estimate of stable earnings, that's good information. We're very good at that in estimating the stable earnings of a company. We're very good at that. But we're very bad in extrapolating, in forecasting. The focus of value investing is simple: to focus on what you know for sure. Focus on the current. And the next, maybe extrapolate. So meaning based on the current, on the sustainable earnings, estimate a value. But then the last priority is forecasting. We don't want to forecast. So that's why we always start with the balance sheet. So I will not discuss this. But I'll share this with you anyway. So instead of valuation, we focus on sources of value. So we start with the balance sheet, finding safety in the assets. But as I said, there's a problem here. The problem is balance sheet is understated now because we don't consider intangible assets. So you have to find a way how to adjust. So there are many good books on this, and they're good study and academic by Baruch Lev on how do you value brands for Disney or brands for Coca-Cola. But here, find safety in the balance sheet. What I know for sure is the report card. Not the cumulative report card. What I know for sure is what is existing now, the assets. How much are you willing to pay for the assets? The next, you consider earnings. Again, if you cannot find opportunity on the asset value, we move to earnings power value, determine sustainable earnings. The next step is this. A lot of investors, they invest indiscriminately without even asking the simple question. When you invest, what are you paying for? How much are you paying for the earnings of a company? That is the second objective. And only then we can move towards incorporating growth, the franchise value. First things first, we have to ask the question. Incorporate strategy. So in traditional value investing, it's 100% quantitative. In modern value investing, it's 50%, 50-50. In fact, it's 70 qualitative, 30 quantitative. You have to consider competitive strategy, competitive economics. You have to understand game theory. You have to understand why, because you have to opine. Should this company be valued as if it's dead, liquidation concern, or should this company be valued as if it's alive? That's the only time. Remember this, when we do this Columbia way, we are compromising our value. The intellectual forefather, sorry, that's Donald Trump. The intellectual forefather tells us to look only at asset value, but the opportunity disappeared. To be fair with Benjamin Graham, opportunities were there. So why make your life difficult when opportunities are there? He doesn't want to get, he is very rich, he died very rich, but he doesn't want to get too much, very, very rich like Warren Buffett. Okay. And then the next, if you don't find any opportunity in the asset or using the balance sheet as it is, then we compromise. We look at earnings. And then we compromise. We look at growth. Okay? But then what I want to challenge you is this. Number one, do not be moralistic that you don't want to compromise, that you're a purist. I want to leave room for people who wants to compromise, but remember, when you compromise, you have to know what you're getting into, what you're compromising on, okay? Because we have to call it as that, no compromise. So wait, let me leave this, and I'll send this to you. But here, Michael Maubasan from Columbia Business School published what are the key skills that you need to learn. So this is like your syllabus. If you don't want to attend my courses, that's fine. You don't need to do this. You don't need to attend seminars, but I want you to start. I want you to start. Good karma for me also. I want you to start now, and you can do that. But you have to take this seriously. So what do you need to learn? In your syllabus, you have to be good in accounting, because accounting is the language of business. You have to be able to read balance sheet, financial statements, annual report. You have to learn valuation. So the Moderan, so I'll recommend some resources. You have to learn microeconomics, economics of strategy. I also recommend some resources, because again, how do you know whether there's a sustainable competitive advantage if you don't know what are the drivers of competitive advantage? And not all 5 forces, Porter's 5 forces works. Only few will translate to investment value, to value for investors. No, yeah. Financial differentiation really doesn't matter. So I was taught during my business when I'm studying business subjects, I was told the differentiation, product differentiation is a key competitive. Unfortunately, that's not based on my study of great compounders. Product differentiation is not the key. Okay, there are network effects to be one. Okay, so anyway. Financial markets. Okay, you have to understand how markets work. To understand Mr. Market, you have to understand when market stumbles. You have to understand, like Pat said this, no? Kelly criterion, probability. It's very important. This is an odds game. There is no 100% in investing. It's always about betting when fish were the first fish swims, no? When the odds are for you and not against you. And more importantly, because investing is changing fast. Okay, because markets is smart. Especially in the US, where you can buy and sell, where you can long and short. So there's little friction cost, and there are many players. There are many motivated individuals. You have to have ultra learning skills. So I have a recommended book for those of you who are studying this book. Ultra Learning, one of my favorite books. He's an inspiring story. He has a blog also, Scott Young. So what he did is he used, because now you have so much resources, of course, Coursera, EDX, MIT. So he finished an entire syllabus of computer science using MIT courseware. So he's telling some practical ways, no? And to a certain extent, I did what he did before. So when I set aside my MBA money that I save for MBA to study value investing. So how do you create your own syllabus? How do you stay disciplined? How do you test yourself? Ultra learning. That's the skill of this new century, the super learning skills. Memory. So now, okay, mental math is important. So I know that some people don't value mental math, but it's important. Why? If you're reading, if you want to have a wide sample of companies that you want to study, you have to be able to calculate market capitalization, price to earnings ratio, price to earnings multiple, EBITDA, some sense of the numbers, a number sense. So mental math is important. Memory is important to recognize patterns. Behavioral finance, we discussed some. When will markets, when will individual be not rational? Because that's how you make money. And when you will be not rational, the easiest person to fool, as what Charlie Munger says, is yourself. So when will you not act? When will you not act on this information? Okay, filtering the signal from the noise. Okay, this one you will understand as you get smarter investing. What's important? Okay, Pat discussed this position sizing, when to bet, how much to bet when you are certain, and how much less. How position size, how much to bet when you are certain. When do you bet big and how much? And more importantly, reading. Okay, so I know. So I must confess to you, when I joined a bank, one of my superiors then told me that yeah, it's hard for me to be successful in the sell side because I'm not street smart, I'm book smart. Yes, I'm book smart. And at that time, I have this insecurity. I enrolled in John Robert Powers. I read Dale Carnegie's How to Win Friends and Influence People. I tried to be likable. But then you know what? I realized that the things that matters for me are not the street smart skills, at least from an investor perspective. And now, I'm no longer ashamed. I'm very proud to say that I am book smart. And these books, gave me possibilities that I have never imagined, that I've never imagined before. And my challenge to you is this: it's as simple as that. So great, George Soros is a reader. John Templeton is a reader. Who else? Carl Icahn is a reader. Bill Ackman is an extreme reader. Who else? Warren Buffett is a reader. Jamie Simons is not because he's a quant guy, but he's a reader, I think. He's a mathematical guy, I think, but maybe not reading in the Warren Buffett sense. Buffett and Charlie Munger are leaders. So do not underestimate the power and importance of reading. And recently I attended this gifted education program here in Singapore, parenting seminar. We were told that if you have a kid, one clear sign that your kid is a genius she's reading passionately, voraciously at an early age. Okay? Yeah, I agree. Leaders are readers. I agree. Steve Jobs is a reader. Everyone. Elon Musk, he was asked. Elon Musk is okay. That's why now so I kind of look down on that statement that the book smarts are not. Elon Musk was asked, how did you learn about this new industry space? Oh, just by reading. He's the most street smart guy I can. He solves big problems and he learns by reading. So don't believe that. I don't know, it's a cultural bias or whatever, right? But do not believe that. Reading, I agree this. Leaders are learners and readers. Leaders are learners and readers. Okay, so sorry, that's a tongue twister. Now, to start now, watch this video, Becoming Warren Buffett. And what you can do now is this. What worked for me when I started, I read these 4 books, easy books to read. The first book is The Warren Buffett Way, to get you started, the starter pack. Now, if you are more of a novel reader, or like if you like Against the Gods, this book, Education of Value Investor, is a very touching memoir on value investing. So he started on the sales side. He didn't like the culture in the sales side. How did he become a value investor? Guy Spear is one of the good value investors that I know. His mentor is Monish Pabrai, the Dando investor, one of the great investors I know. And he has more, sometimes when you read Warren Buffett Way, Peter Lynch, not applicable in our markets. Dando investor may be more applicable in the Philippine context. Okay? What does it really mean to have this business mindset? That is answered by Dando Investor. Now, to inspire you, because he's a great writer and a funny writer, read this book, Beating the Street by Peter Lynch. It inspired, because I studied investors and I asked for what are the books that got them started. And surprisingly, Peter Lynch, old book, an old book. It's an old book, Beating the Street. Although he stopped, he's still investing up to now, on a personal basis. Podcasts. My favorite is Farnham Street. It's not here, sorry. Farnham Street by Shane Parrish. Okay, so he's a very good guy if you want about thinking. Now, if you want about investing and you're a baby investor, listen to this podcast by Phil Town and Daniel Town. So these are a father and daughter duo. So they explain investing quite well, really well. I must say that for new beginners. So even my wife, I asked her to listen to this podcast because Daniel is a relatively newcomer in terms of investing. The dad started investing quite late at age 50, but he's a moderately successful investor. And and then we study billionaires. Also a good podcast if you want something, if you're more of a listener. Okay, so these are the courses that I don't want to sell this. I'll share it with you. So I just offered a comprehensive course on value investing. It's a 5-day comprehensive course. And it's very well reviewed. I've been teaching for 10 years. But I was amazed by the evaluation I got here. And it's almost also transformative to me as a professor. And I'm very happy to teach this course. But again, you don't need to attend the course. Okay. Thank you, Salve. I think I'll let you know. Please send me an email. Give you my email. Then I don't want to spam you, but I write regularly. Come up with a newsletter and share resources. So if you want, I can share with you. I'll give you my email after this session. And this is the syllabus. So around the process, so again, I would not dwell into this. Now, for those of you who want to get started, again, you will not be able to understand. Oh, thank you, Salve. You will not be able to understand value investing. Thank you. Yeah, I will respond. Yeah, you can also add me in Facebook, so it's easier to communicate. Free resources, there's a lot. Coursera has a good management, financial accounting. Wharton has a good financial accounting. I took it myself. But the Moderan is a very selfless individual. So he has Accounting 101, Investment Philosophy, and Valuation courses. There's no excuse for you. You don't have to pay for my courses if it's expensive. And in fact, in some ways, this is better than I'm not sure, but I'd like to think that mine is more practical. But this is a very good one. If you don't have the resource to spend, you have no excuse. Because a lot of things, I can recommend some resources on each of these pillars. You don't have to attend my course. Because my objective is to just to build a network of like-minded individuals and to make the community and restore the historic value of value investing to the CFA Institute and of course to the wider public. I attended this course, value investing, good one. So, but if you don't want, I can share the resources. So it's quite expensive, $4,000. $3,750. But it's okay. It's for value. And I value education a lot. So I have a rule to spend 10%. But I don't necessarily do that. But so this then study about history, psychology. You have to learn more about yourself. So this is a sort of a syllabus. Study about margin of safety, where to get ideas, competitive strategy, economics of strategy. So in the end, I'll share with you my MBM. This is from my MBM model. And how do you apply value investing in parenting? So I have some interesting ideas on that one. So I studied, did you know that George Soros has a good father and his brother is also, I think, a multimillionaire? George Soros' brother is also, so he has an interesting parenting technique. So they all play Monopoly for some reason. So there are a lot. So they all studied probability at an early age. The gambling games, it's a cultural taboo in the Philippines, but teach your kids poker, teach kids bridge, because these are good ways to think about odds and whatever. And teach your kids economics. And I have one good, I can share with you free copies. Ace of Fable is a good book on investing. Very good book. A lot of good values there. And and study Clone, the Good Investors. No, I like Mono. Okay, but at least it gets you interested, in money. At least that part, like the money, liking money as So here, so how to commit. So I want you to commit now and don't waste this opportunity. Maybe for some reason, so I'm a very superstitious person. So maybe fate led us together. So I want you to use this opportunity to commit to do something, to commit to continuous learning, to compounding. Okay. So Warren Buffett was, Charlie Munger was asked, this is Charlie Munger, how do some people get wiser than other people? Partly inborn, you cannot do anything about genetics. Partly temperament, that one you can do something. Warren Buffett has become one hell of a better investor since the day I met him long ago. And so have I. So the game is to keep learning. And I don't think people are going to keep learning who don't like to learn the process. Yes, the bromance. So a good book, Working Together, by Michael Eisner, the Disney CEO. You would see how close they are as partners. And this is your syllabus. And again, I will share this with you. Okay, so first to learn accounting, and these are the best books. okay, on accounting. So I'm an accountant, so I'm biased. So I try to read this again. So learn about free cash flow. Learn about the end of accounting on intangible assets, financial shenanigans, and the case study of Noble Group. I'll send it to you. Valuation, the value investing book by Columbia, Bruce Greenwald, must read. It's a new edition. I read the first edition many times. So I have multiple copies of this book. Yes, I love that book. I love that book, Rendell. Poor Charlie's Almanac and Seeking Wisdom. The Peter Bevlin books are very good books. The Modern books are great, but this Rappaport book, not that well known, it's a very good book on valuation. Teaches you how to actually do it. Now it's some sort of an intellectual show off or macho to say this, but I'm telling you, at first I hated security analysis, but I love security analysis now. So if you want to have this Bible study in security analysis, I might, I want to also do that because so I learned. If you don't have the time, attend the valuation courses of Damodaran. He has a mini valuation course for professionals. Okay. Strategy. So I'd like to say, because I would like to look smart, Michael Porter. So I read these things, but it's not, don't read that. Don't read Michael Porter anymore. Yeah. Okay. Good. Kenneth, good. Yeah. Good. I agree. And also his recent book, I forgot to write here. If you're in transactions advisory, read the book Narratives and Numbers by Damodaran also. I think it's better than the little book. So on strategy, don't read the Michael Porter book. Just read this book, a shorter one, 150 pages, Understanding Michael Porter. And then this book, I like this very much. Competition Demystified by one of the value investing guru, Bruce Greenwald. About competitive advantage, another small book, The Little Book That Builds Wealth. So this is a good series. Please read those. By Pat Dorsey. So I like Pat Dorsey. So it's a very practical and teaches you how to actually do this. And I like the Peter Thiel book because it opened me to this mindset to look for monopolies. Okay, monopoly is bad. Okay, I know we have antitrust rules, but if you can find a monopoly, or monopolistic-like company, usually these are good investments. Unless, of course, there's a regulatory risk. I did not take MBA, so I have to study business model by myself. So Michael Porter is a hard read. But I learned to read, yeah, it's like security, not like security analysis, but also hard. This good model, business model generation about the different canvas, or paintings, or different type, dim sum type of discussion on what are the different business models. So you get this mental model on how to analyze a company, how they make money. Okay. About history, market history. Read about market history. We have to know what happened in the past. So my favorite book is, so this one, Mastering the Market Cycle by Howard Marks. Ray Dalio's book, The Big Debt Cycles. It's a good book. A recent book for free online, Changing World Order. It's also a good book. And also the 100 to 1 the stock market, and a free book that I'll share with you, the 100 to 1 wealth creation study. It's a good book. Financial market, you can attend this Robert Schiller course. I like it. Oh, this one. Okay, so it's here. Was it you, Carlo, or Kenneth? Peter Bernstein book. Okay, risk is the most important. Okay, Carlo, risk is the most important thing. I'd like to repeat. People tend to look at, sometimes refer to risk in a derisive manner. No? Oh, this is just compliance stuff. No, wrong. Risk is the most important thing. Risk is something that you can understand. Return cannot. There's thousands of explanations. Risk is the most important thing. If you understand risk, you will be able to, return will follow. If you're into reading memoirs of great billionaires, so I have this very great book written by Felix Dennis, How to Get Rich. It's not a respectable title, but it's one of the most meditative book on how to get rich. Felix Dennis is the founder of Maxim FHM. So I'm not saying it's good, but he wrote the most poetic and meditative book on how to get rich. You know what he said? He said this: most people are getting it wrong. It's not about the return. Entrepreneurship is about risk. Entrepreneurs are good risk managers. They take care of the risk. They manage the risk first, some through banks by borrowing, some through the capital markets. So remember that. So yeah. And then here, this book will change your life and change your thinking. The book by Nassim Taleb, Fooled by Randomness. Now, it's a relatively hard read. Yes,
the Kahneman book. I don't thinking Tversky died already. He didn't write the book, but he's one of the. You're right, Amos Tversky is one of the partners of Kahneman. It's a good book also. But I love this book, Fooled by Randomness. There's a reason why. Taleb is an arrogant man. I spoke with him in Malaysia when I launched my book on risk management. He's the keynote speaker. So yeah, Kahneman, yeah. So I read that's also a good book. So I spoke with Nassim Taleb, and yeah, he's an arrogant man, even in person. So a funny story there is he was paid $100,000. I was paid only a few $1,000s, but I spoke for the whole day. He spoke for 1 hour. So he's a celebrity speaker, but he's very intelligent. To me, he's one of the greatest social philosophers of our time. He understands risk, asymmetry quite well. Please read this book, Fooled by Randomness. There's so many asymmetry that's out there. So it's like compounding. It's either you earn it or you pay it. Read this book, The Hidden Role of Chance in Life. And this convinced me to adopt a non-predictive view of the world. Now, if you want something that's more applicable, Nassim Taleb tends to repeat. I don't like the Black Swan book. I read it, but I don't like it. It's just a rehash of Fooled by Randomness. But some like it. Some said I'm wrong, but yeah, it's up to you, right? He hates Gaussian. That's what he attacked. He hates normal distribution. He hates value at risk. He hates normal distribution. So he's a hater, but you can understand why, because he has been an options trader. Now, a very practical book that you should read once you read Fooled by Randomness is this book, Anti-Fragile. So what does anti-fragile mean? Anti-fragile is this, that you gain from disorder and disaster. It's more than resilience. I know resilience, grit is a popular word now, but there's something that's not in the English language where you get better, you get stronger in adversity. You gain from disorder, from COVID or whatever, like an octopus or like whatever. So this is how he convinced me to rethink about my portfolio management philosophy, to adopt a barbell model, how to be anti-fragile. So expose yourself to fragility, meaning don't expose yourself to negative black swans. That's why the 90% conservative. Expose yourself to positive black swans. That's why the 10% speculation. Okay? So about prediction, again, you cannot predict. You cannot predict. You will see it in this book by Philip Tetlock. Experts are not good predictors. No, okay, you can predict the small things, but the big shifts, the thing that could kill your investment portfolio, you cannot predict. And therefore, his advice is simple: be humble, adopt a non-predictive view of the world. Yeah. Yeah, it's okay, because I think you're catering for traders also, which is okay. I mean, but for investors, it's all, yeah, sometimes to me it's not productive. Black Swan also. Oh, this one, I love Howard Marks. I read everything that he writes many times. I have multiple copies of this book, The Most Important Thing. So he has different most important things. Read this book. He has a podcast as well. He reads his memo in that podcast. His latest one, to me, is one of the best. Now, life-changing book, is this book. If you want to learn about yourself, this book is a thick book, Poor Charlie's Almanac. Read this. So I know that I think Carlo, you recommended Bevlin. This is a better book. Bevlin is good, but this one is better. You learn from Charlie Munger. I'll send you links on Charlie Munger's speeches. And yeah, Thinking Fast and Slow, Influence, even if you're not into investing. The Robert Cialdini book, you cannot go to life without reading this book. Because why? A lot of people will compel you to do something, will sell you stuff. How do you protect your mind? How do you protect your mind from being persuaded? And how do you persuade also? So this is a good book by Robert Cialdini. Charlie Munger liked this book so much that he gave Robert Cialdini 1 share of Berkshire stock, which is now worth $360,000. And in the recent podcast, he said that, yeah, he kept that share. He never sold that share. Market history. Okay, now this is so we have to be aware. How did our previous investors stumble? Read about what happened in the past, the Great Depression. This one, manias. The Charles Mackay book is a classic. The Crowd, a Study of the Yes, Patrick, the classics. Okay, yeah. I'll give you some of these have free copies, so I can share it with you. Of course. Okay, so here I'm not a momentum trader. Okay, do you find, honestly, Carlos, I don't find Neil Ferguson to be a good writer. I read this book on the Rothschilds, but The Ascent of Money, I struggled finishing that book. The Rothschild also. I mean, I'm just being honest, but it's a good history. And also, and if you want to shortcut, yeah, it's hard because he's a Oxford historian. He's very smart. His Kissinger book, I tried to read. I would rather read the Walter Isaacson biography of Kissinger. But on Neil Ferguson, he has a BBC documentary available in YouTube, or if not available somewhere, The Ascent of Money. So it's also a good, yeah, it's a good reading. And if you want to learn about how to time the market, so yeah, I mean, I'm not into this, but I've read this. I like The Alchemy of Finance of George Soros about reflexivity. So it's a good book. But this one, Reminiscence of a Stock Operator, is also a classic, a good one. The annotated version, please read that if you have time. But second priority. And also a good book, The Education of a Speculator by Vic Niederhofer. But don't believe it because he lost billions of dollars. He keeps on losing money many, many times. Now, on position sizing, so what I think what Patrick earlier mentioned, Kelly's Criterion, Fortune's Formula is an entire book about the Kelly's Criterion. It's a good book, story book. So Carlos, if you like Against the Gods, you will like William Poundstone. Dando Investor, most practical book on investing, and the Warren Buffett portfolio. Again, learning skills. So I have it here. James Marcus Bach, Buccaneer scholar. So he's the son of the one who wrote Jonathan Livingstone Seagull, an inspirational book. So he's a software engineer. He has some interesting things about how to supercharge your learning. So I'm into this. So I will recommend some podcasts. So one of the edge we can have is our ability to learn fast. Ultra Learning, good book. Okay. And then I follow James Clear because he's a very simple writer. And Atomic Habits, wow, very good book. So story, nothing new. Malcolm Gladwell said this in Outliers. Daniel Coyle in the Little Book of Talent and Talent Code said this. But if you want something that's actionable, read Atomic Habits. The message is simple. Don't focus on big things that you need to change. Focus on the small things, the atomic unit. If you want to read one book, don't think about reading one book. Think about reading one chapter. If you cannot read one chapter a day, it's okay. Think about reading one page a day. If you cannot think about reading one page a day, think about one paragraph. If you cannot, just one word. And you know what? You will get started. I forgot to say here how to read a good book. And another book that you must immediately read, I will send it right after this, by my favorite thinker, Naval Ravikant. I read this many times, like maybe 3 times now in this January alone. The book, and it's a short read. And you can follow him in Twitter. So if you're into the new economy thing and not on the value stuff, he's a great thinker. He's one of the early. If you read the Bitcoin Billionaires, he's one of the characters there. One of the patron saint of Silicon Valley venture capitalists, Naval Ravikant. He didn't write a book, but someone compiled a book. I think Ravikant's Almanac or something, Naval's Almanac. And then I have a course here that I enrolled in. If you want, I'll share with you. Because, okay, take one step backwards to make 2 steps forward. You have to be very good in reading and absorbing information. And this is a good book it's good course by Shane Parrish. I downloaded the video and the materials. I can share it with you. Send me an email. Okay. Now, before I leave you, this is an inspiring story, a fishing guide who found the now legendary, arrogant hedge fund manager. If you followed what he did recently on his put option, Bill Ackman. He started out as a value investor, a Warren Buffett fan. In fact, he appeared in 1994. He asked questions in that Berkshire meeting. So he met this fishing guide, okay, and then, okay, I'll send this to you, Chris. Okay, he recommended these 6 books. Okay, no, sorry, not 6, a few books. 8 books or maybe 9. 9 books on investing. So I can share this with you. So Margin of Safety, Beating the Street, Quality of Earnings. So he asked this guy, a fishing guide, to read these books. Okay. And then you know what? This guy diligently read the book, and then he applied for a job with Bill Ackman. And Bill Ackman, okay, I'll send it. Bill Ackman, he read these books. Okay, so some of them are short, some of them are long. This one is long because these are the letters of Warren Buffett. So he recommended these books, and then this guy, the fishing guide, read this, and he applied for a job, and he got the job. And you know what? He retired early because he didn't want investing, but he was successful. He became a multimillionaire. So if someone with no finance background can do it, what more you guys who have CFA or thinking of doing CFA, what more you? So yeah. So I think we can, you just have to start somewhere. We underestimate what we can achieve in 1 decade. Remember T. And I'm also planning, so I have so many plans, but yeah, this is an ambition, maybe not this year, maybe a few years time. So in a Jewish tradition, so they have what they call Daf Yomi. They read the entire Talmud, 1 page a day, every day, for the longest running book club for 7.5 years. Then they finish one cycle, then read again, read again. So I'm planning to read, I hope maybe not seven, because in not 7 years, maybe we can come up with a Bible study group to read the Berkshire letters and to learn not just about investing, but about life, about business, and about integrity. So yeah, so this one of my favorite movies, Ratatouille. Okay? Yeah, thank you, Carlos. Ratatouille said this, no? One of my favorite scenes, Gustav, anyone can cook. I believe in investment, no? Anyone can invest. This is my firm belief. Anyone can invest, but it's not for everyone. Again, anyone can invest, but it's not for everyone. Why? It is genuine hard work. You have to give your soul. You have to give everything. You have to sacrifice many things. Like I don't have too many social life. I say no many times. Yeah, so that's yeah. So Tony knows this because we worked together before. I always do my best to try to say no. I protect my morning time, my lunch time as much as I can, but it's hard for markets. But I try to do that as much as I can. But it's it's sometimes it feels terrible, especially in our culture. Yeah, but I have to do it. Now, the reason why I'm doing this is because I'm continuing a long tradition of teaching that started with Benjamin Graham and then Warren Buffett, who also taught very briefly in a high school in Omaha, in Nebraska. So yeah, so I hope you learned something. And sorry again, I didn't mean to disrespect you by extending the time required. But thank you for your time. I hope you learned something. So I think this is the record, 1 hour and a half, I mean 50%. This is overvaluation. Yeah. Okay, thank you for your time.
Thank you
Yeah.
so much, Philip, for the very insightful discussion on value investing. I actually learned a lot. And for me, I think what's difficult, like in a webinar, no, on finance, is that one of the normal criticisms that we get after the session is that it's not practical. But in this session, I cannot say that because everything that you said, it's very much related to life. Anyone can actually relate to it. Anyone can just